Welcome to class. This is SFM, and our main focus is on investment appraisal, aka capital budgeting decision. All right. Now, there are lots of things to discuss in this topic, but trust me, there are so many things that ICANN would not even test under this topic. Okay. So, what is investment appraisal is out of it. ICANN will not test it. What is capital expenditure is out of it. ICANN shouldn't test something like that. So, I will just do an overview of what capital budgeting or investment appraisal is. Then the focal part that I can usually test is the technique. Okay, capital budgeting technique. I'm going to address it. Then we'll take as many questions as possible. So let's start this way. So, okay, let's say we have expenditure, right? Every business must incur expenditure, isn't it? Every company must incur expenditure. Now we have two basic types of expenditures. We have what we call capital expenditure, and we have what we call recurrent expenditure. Okay. Now you see this guy, this recurrent expenditure is the expenditure that you incur on a day-to-day basis. The idea is that this expenditure is not expected to create a capital asset or is not expected to create an asset. So usually these expenditures are usually taken to the profit and loss account as an expenses for the period. And that is what you call OPEX, operating expenses in your P&L account. That is recurrent expenditure. Then you see this big guy here, capital expenditure. These are money that you spend, all right, but they are intended to create an asset. Simply means that the end product of that money you are spending is to create an asset. And what would be that asset? The asset may be like a machine, can be like a plant, can be like a building, can be like a factory. You spent money to acquire those things. So what you acquired is will be treated as an asset. So basically, this money goes to the balance sheet. Okay, it goes to the balance sheet of your financial position, balance sheet or your financial position. So our basic discussion here would lie under the capital expenditure, which we call capex. Okay, we should call capex. So under this topic, we're looking at how does an organization finance capex? How do they finance capital expenditure? Now, no company in the world, name it, can finance capex without having a good structure or a good capital budgeting structure. Okay, so that is it. So any company that wants to finance capex must first of all have capital budgeting, or must first of all budget for that capex. It's just like saying you are on the street and you perceive akara. You say, this akara is something where you can just buy it. But you're on the street and you see a car, okay, in a car lot where they usually showcase car. You can't just say you want to buy it when you are no OBO. I don't know if you understand. So even if you go there to check for the price, you will tell them that you're coming back. You should go and save. So that savings that you are going to do is more or less like saying you are going to budget for it. That's what we call the capital budget. So capex are usually financed under a structured capital budgeting decision. Does that make sense? Now, it therefore means that a company should plan to finance capex. I will remove this person. A company should plan to finance capex when they have a good budget. When they have a good budget in place to finance it. It's as simple as that. Okay. Now, two things about capital expenditure. You will incur money in it. Because the money you incur is creating an asset, you will get back money. You get back money. Simple. Those are the two basic things. So you will incur money, all right? And because the money is tend to create an asset is required to do what? To give you back money. Those are it. So when you're looking at the capital budgeting question, you always see things like inflows and outflows. It's as simple as that, inflows and outflows. Now, your outflows, okay, your outflows can occur either in year zero or in subsequent years. Just jot down the point. I'm just giving you the direct points to solve questions. Your outflows can occur in year zero or in subsequent years. I'm going to explain. Now, CapEx, capital expenditure, they are longer term budgets, they are longer term expenditure. Okay. It simply means that the impact of that expenditure can span into 10 years, 5 years, 15 years, 20 years. Imagine Dangote building a refinery in Lagos. That is a capital expenditure. And that refinery can begin to the next 50 years, to the next 70 years. That's a capital expenditure. And before Dangote was able to build that refinery, he incurred money, he spent money. That money, we'll call it investment, capital investment. Okay, we'll call it capital investment. And I've said that the capital investment can be incurred in two feeds. So one is in the year zero or in subsequent years. The capital expenditure you guys have been doing at PM level and at maybe university level, we only tell you that and there's an investment in year zero. That is the baby boy. That one is a baby capital expenditure. In some capital expenditures, okay, question, you will hear that ICANN will tell you that even in year two, the company incurred money. In year three, they incurred money. In year four, they incurred money. So it simply means that it is not only in year zero that you expend money. Okay, that is where the idea of working capital comes in. You can spend money to keep running that business as working capital over the years. Okay, so we're going to be looking at questions like that, where the question only states that capital expenditure are incurred in the first day of investment or the first year of investment, and where capital expenditures are incurred in subsequent years. That is to say, when I mean capital expenditures are incurred, I'm talking about working capitals are now incurred in subsequent years. That is what it means. All right. So year zero is also known as time zero. Okay. Or you hear I can use the word now, or you hear I can use the word today. All right. Those are what it means. Then you get money back. You get money back. So you get money back in terms of income, I mean revenue. Now that money that you get back, okay, you have to deduct your operating expenditures, deduct expenditures from that money to get your net profit. Because technically, what you got back is just income. All right, it's just income. So you have to convert your income to cash flow. And I'll tell you why we are converting to cash flow. Just calm down. I'll tell you why we need to convert to cash flow in some cases and why we need to convert to profits. Okay, there are two different things. So the money that you get back, it is either you leave it at cash flow, okay, or you convert to profits. So these are the two monies that we can use to evaluate a project or a capital investment. Very simple. All right, is there anything that you need to know? Don't worry about this. Quickly, this is where I want to focus on. We don't have much time. Now, this is where we'll talk about the capital budgeting technique, CBT. Okay, the capital budgeting technique. All right, so here we're trying to talk about what are the various ways that we can actually use to evaluate a project. Trust me, before Dangote was able to build that refinery, some analysts have sat down and did a projection for him. Okay, they've analyzed the project for him and they've told him that, look, oh, for you to complete this project, you are going to incur so billions of dollars. And if this project survives and you are able to launch, okay, it will take you so number of years for you to get back the money. Or this is what you're going to get in year one, this is what you're going to get in year two, this is what you're going to get in year three. Now, for the analyst to give him those information, they may have used the technique. They may have used, are you getting that, a strategy. They would have come up with a tool that they have used to analyze this project. And that tools or those tools are what we call capital budgeting technique. Okay, so we have two basics. Okay, we have basics. We have the traditional, also known as non-discounting cash flow method, non-discounting cash flow method or technique. Then the other one is going to be modern, or what you call discounting cash flow technique. Okay. All right. So these are the basic two that we have. Now, they call this one traditional because it does not involve the time value of money. Okay. So there's no way, okay, in the whole world that you are trying to solve investment appraisal question and the person that is trying to solve it does not understand what we call time value of money. Time value of money. So the word time value of money, okay, it's actually the value of money per day. Okay, it simply means 1 naira today can be different or will be different from 1 naira tomorrow. What your 1 naira can buy today as we speak, it may not be able to buy it tomorrow. So that's what we mean by time value of money. So money have value per time. Okay. As time passes by, the value of money changes. Okay. If you had 1 million naira 5 years ago, you were a big boy. But if you have 1 million naira today as we speak, you have not even started life. Okay, you have not even started life because you cannot do anything. That's what we mean by time value of money. So therefore, this traditional technique, the way we calculate it, the formula does not actually give room, okay, to incorporate time value of money. And that is the weakness in this particular method. Makes sense, Abi? But you see this modern or discounting cash flow technique, this method gave room, okay, for, to evaluate a project using time value of money. And that is the strength in this particular method. That is the basic strength in that method. However, let's further break this down. Now, under the traditional method, okay, under the traditional method, we have the ARR, or what you call the return on investment, okay? Accounting rate of return, or ROI, return on investment. Some people call it return on capital employed, right? Return on capital employed. So, and we have the payback period. Those are the basic two under it. Now, you see modern, we have a lot, okay? We have the MPV, we have the IRR, we have the profitability index, we have the MIRR, and we have the discounted payback period. Discounted payback period. Don't worry about what they gave you here, okay? That's why you have a lecturer. Don't worry about just these two. So I'll tell you more. All right. So these are the two basically we have under the traditional method, and these are what we have under the modern method. Okay. So let's take it step by step. Let me just explain what these are, how you can compute it, and let's dive into taking some questions. Okay. And I'll give you ICANN cheat code when it comes to this particular topic. Now, the first one is your accounting rate of return. Your accounting rate of return, ARR. Now, this is not new. If you have done PM, you have addressed this, right? You have addressed this under maybe divisionalized performance management. Okay, you must have addressed this under what do you call it? Issue analysis, raw return on investment, isn't it? So the formula for this is actually net profits. Okay, all over. Everybody knows this. Now, this is the only, and I repeat, this is the only method that makes use of net. That was why when I started, I told you that the cash you get back can be divided into your cash flow and your profit. So when you are computing for ARR, okay, what we need to compute for ARR is profit, not cash flow. So this is where the difficulty comes in. ICANN knows, okay, and they have a plan towards your failure and towards your success. So what do? They may tell you to solve an ARR question, but what is given to you in the question is cash flow. Now, if you are not smart enough, you will use those figures like that. But if you are smart enough, you know that from the formula, it is net profit. So therefore, cash flow would need to be converted to net profit. That makes sense. Okay? That makes sense. Now, the question is, how is the conversion done? So let's talk about net profits. Okay? And let's talk about cash flow. Now, for capital budgeting, right? The basic difference between these two elements is depreciation or notional costs or non-cash transaction. Let's put it that way. So the difference between your net profit and your cash flow is simply non-cash transaction. And in many cases, in many examinations, the non-cash transaction that is usually included is depreciation. That doesn't mean that depreciation is the only non-cash transaction. Okay, don't say I said that. So sometimes ICANN may go further to bring in a notional cost, like owner's transaction. Okay, a notional cost. Okay, national cost, just like saying the owner of the business collected money from the business and he said he's going to pay interest. In reality, will he even pay that interest? So that is just a national cost. Okay, it's an owner's cost, an assumption. Let's put it that way. So that is a non-cash transaction because he will definitely will not pay that interest. Because even if he survives to pay the loan, it's upon talk and talk and talk and talk. Then Another thing can be any other non-cash transaction can be provisions. Provisions. In reality, we don't really set money aside. It's just a concept. Let's say it's an abstract concept, an abstract practice. We just do it, but in reality, we don't set money aside. Okay, we don't set money aside. Okay, and is my voice stable, please? Is my voice stable, please? Is my voice stable, please?
No, I'm fluctuating, sir. Sometimes you can hear it, sometimes you can't. So it's fluctuating.
Okay, can you hear me now?
Same here too.
Can you hear me now?
Yes, please. Yes.
Yes.
Okay, please. Just thank you for the person that called my attention to it. Just let me know. Okay, just let me know. All right. So I said these are examples of non-cash transactions that may occur, that may be in that particular question. Okay. So now we're talking about how do you convert net profit to cash flow? Or sorry, how do you convert cash flow back to net profit? Anyways, right? Because when you are solving ARR, I have said you needed your net profit. So you have to convert cash flow. If it was cash flow that was given to you in the question, you have to convert your cash flow to net profit. And there will also be a need for you to convert net profit to cash flow, maybe in other methods. So let me teach you the simple thing. If I can give you cash flow simply means profit before deducting depreciation. It's as simple as that. What we call profit before depreciation in your financial accounting is known as cash flow here. That is what it means. The same thing. So what you call cash flow here is the same thing as profit before tax, before depreciation. All right. So when you are giving cash flow, let's say 10,000 naira, just go and deduct depreciation. Let's say 2,000 naira. Okay. What you get is 8,000. This 8,000 becomes your net profit. Please, is this one clear? Are we good? Are we good?
Yes, boss.
All right. So the same thing happens if they give you notional cost or they give you provisions. Just go and deduct them. Okay? Just go and deduct them. Then what about if you are giving net profit and there will be a need for you to convert to cash flow? It is simply net profit plus depreciation. It means that depreciation you have deducted, go and add it back because it is allowed to add it back. You add it back, it will come back to 10,000, which makes it what? Cash flow. So these are the ways you can convert. SFM students, be careful. Please be very careful. You'll see this a lot in your questions. Very simple. All right. So that is all about ARR. Okay, that is all about ARR. The last thing about ARR is decision rule. Decision rule. That will be the last thing I'm going to be talking about. The decision rule. The decision rule. You know, one thing about what makes accountants different is that some people knows how to compute. Some people knows how to compute and they know how to interpret. And those are the people that sells a lot. So in this case, if you have computed, you would need to know how to interpret. Okay? Don't forget the answer you are going to get. So how do you know if this investment is actually viable or not using ARR? The fact is that I can give a benchmark percentage. They call it management intended return on investment. That is what management are expecting to get. So if they tell you that management are expecting to get 10%, or shareholders are expecting to get 10% from any kind of investment that they give, that they want to invest, then after you are done analyzing this thing, then after you have done analyzing your ARR, you now got 10%. I'll come back again. Decision rule. I said, when I can give you a question on ARR and they want to give your decision or your verdict on that question, okay, simply means that they want to tell them whether the ARR you have computed, whether it is accepted by management or not for the purpose of investment appraisal. And I said, if they want to do this, they will give you management intended return on investment or management intended ARR. So let's say that management or the shareholders are expecting from any kind of investment they want to do. And after you have done your ARR quotation as the guru that you have, you got 8%. Somebody tell me, would you go with it or not using ARR? Management intended ARR is 10%. What you have
I
computed,
can't hear you,
Repeat all the
sir.
readers, sir.
management intended
Yes.
ARR is 10%. What you have computed as ARR is 8%. Are you going with investment or not?
You won't go with it.
Thank you. So the answer is you will not go with it because it is below what management is expecting. Okay, it is below what management is expecting. But when you compute, which is above what management is expecting, it simply means that it's a good investment. So you should go with it. Very simple. Are we good? Are we good on this, please? Are we good on
Yes,
this,
sir.
please? Okay.
No,
Yes,
sir.
boss.
So can you explain the decision rule again?
All right. Now, under the decision rule, I said you want to advise Dangote, you want to advise Pathfinder that the investment that they have evaluated using ARR, is it a good one? Should they go with it or should they not go with it? Should they spend money on investment or should they keep their money? And I said, ICANN would give you a rate in the question. They usually call that rate management intended rate of return. You don't need that rate for anything in that question. The only thing you need it for is to compare. What are you comparing it with? You compute your ARR and then compare that rate with the rate that the ICANN has given to you as management intended ARR. So I gave an example. If ICANN gave you that management are expecting 10% of any kind of investment at all, but after you have computed, you computed your own investment at hand and you got 8%. To you, is it a good investment for the company or not? That is the question. Somebody said it is not a good investment, which I said, yes, it is not a good investment because shareholders are saying that, look, if we are giving you money, you are going to give us 10% of that, of your profits. After you are done doing your analysis, you now realize that even the business cannot give you 10%. The business is only giving you 8%. So it is not a good business for you to work into. But what it's good because you can percent for the company to keep. Does that make sense now?
So I'm not hearing you.
Let's manage, please. Let's see. But just keep informing me so I can always come back and say what I've said before. Okay. So what I've said here is whenever management rate of return is more than what you have computed, reject the project. But when management rate of return is less than what you have computed, accept the project based on the ARR that you have computed. The realistic part is that ARR is not really a strong, okay, it's not really a strong way to evaluate a project in reality. And the reason is because of the profits that is being used in the formula. Profit has accounting limitations. It has reward limitations because of the accounting principles adopted. So it may not be a good way to evaluate projects. But however, shareholders tend to understand it more than some other kinds of investment appraisal technique because since profit is in the formula, shareholders are very used to the word profitability. Profitability. So it's more or less like a primary way to measure that the company is actually doing well or not. That is why, we still use ARR. Makes sense, Abi? So SFM level, you have less ARR to work with. Trust me, I can may not even test ARR for a long time at SFM. At FM level, expect big time because you are the beginners, right? You are the beginners. So SFM, I'll let you know where your big deal comes. So let's leave around and let's go to payback period. Now, as simple as this method, payback period. One thing before you say I didn't tell you, your capital employed can either be opening capital employed, Abby, okay, plus your closing capital employed, Abby, then you divide it by 2. So in this case, it simply means that we can use our average capital employed in this formula. Where you cannot get your average capital employed, they should give you your closing capital employed, which is okay. Okay, which is okay. But when they give you opening and closing, and the question is silent whether you should use opening or whether you should use closing, whether you should use average because you can get opening and closing. So just use average, it becomes more meaningful. But when you can, if you know you don't want to pass through the stress of using average, the closing capital employed is also a good way to evaluate this project. But take note that ICANN may specifically state that you should use opening or you should use closing or you should use average. But where they are silent, look at the availability of information and make use of it that way. Is my voice fluctuating? All right, I think that is clear, Abby. Okay. It's clear, Abby? Okay.
So are you recording the class?
Yes, it's clear. It's clear.
Okay. Yes. So let's go on to payback period. Now, payback period is the simplest to compute. Even a 1-year-old can compute payback period. And trust me, it is tested in SFM level, as simple as it is. Okay. The only problem I have with it is that it can be 2 marks or it can be 3 marks. Okay. But it is tested at SFM level. Okay. But sometimes it can be complicated. Now, when we're talking about payback period, we're trying to talk about the number of times or the number of years, particularly, because this is a capital budgeting question, so it goes into years. So the number of years it will take an investment, that building, that factory, that plant, to get back the money that you have invested in it. So under this method, we are ignoring profitability. We are only much concerned about can we just get back the money that we have invested in this assets. Any other thing like profitability can come later. So payback period is much more focused on the cash flow that could pay back the investment. So basically, we don't make use of profit here. The only method that has profit is ARR. The rest will be making use of cash flow. So be very careful in the question. ICANN can give you profit. You would need to convert the profit to cash flow when you are computing for any other method apart from ARR. I hope that makes sense. Now, there are 2 ways to calculate for payback period. We have a payback period where we have even cash flow. The word even is what? The same or equal cash flow. What that means is that if we spend 10 million to buy the asset, to invest in that, that goddamn investment, we are going to be receiving like, let's say 1 million naira every year, annuity. Okay, what you call annuity. So every year, our income will be 1 million naira, or our income will be 500,000. It doesn't change. So when you read a payback period and the question tells you that the company is going to receive 500,000 naira as inflow or as profit or as cash flow every year all through the project, just know that you're looking at even or equal cash flow. But the day or the moment the question tells you that the inflow for year 1 is 500,000, the inflow for year 2 is 300,000, the inflow for year 3 is 700,000, it means that it's not equal. Okay, that will give us to the other one, uneven or unequal cash flow. Okay, then we have to find another means of solving the question. Okay, so for the even cash flow, this is the formula. This formula works anywhere. Even if you're in Japan, it works. When I was in Switzerland, it worked for me. When I even traveled to Ghana, it worked for me. Okay, so what is the formula? Who knows the formula?
Initial outlay.
Initial outlay, thank you. Or capital invested.
I think it's about number of years, sir.
No, okay, number of years, thank you. Number of years. Thank you. Okay, I think let's move this screen to where we are. Let's move this screen. Hold on, please. Okay, this is it. payback period. Sorry. Payback period, we want to get the number of years. So our answer is supposed to be number of years. So this should be our cash inflow. Okay. So let's not get it twisted. This will be our cash inflow. So on that payback period, the answer you are getting is in years. Okay. So the answer you are getting is in years, years and months, whatsoever. So your initial outlay, how much did you spend? 200,000 naira, as the case may be here. So we spent 200,000 naira in this particular investment, and every year we are receiving 50,000. So it will take us 4 years. See it? 4 years, 4 good years to get back our 200,000. Nothing concern us with the other balance. So we are only concerned about this one. But what about if it is unequal cash flow? We are looking at uneven cash flow. So unequal. Now for unequal cash flow, I call it the tabular method. We use the tabular method. Okay. We use the tabular method. So we have to prepare a table, right? Like a table, and use that to solve it. Don't worry about that. We'll solve questions and you'll see how it goes. Okay, I think we have a question here quickly. They said, identify the payback period of projects with the following cash flow characteristics. So look at it. In year 0, you incur 200,000. But from year 1 to year 4, they are all positive, but they have different cash flow. With this, you're going to use the tabular method. So it's very simple. Okay. If I have my years, I have my cash flow, and I will have my cumulative cash flow. Okay. So I can say from 0, 1, 2, how many years? 3, 4. You don't really need to list all the years. I will let you know because sometimes I can give you a question 10 years, 15 years. Don't put your time listing all the years. You may not need it. Okay, you may not need it. So let's start. So the first year is going to be 200,000. I know it is negative. The next one is 80. The next one is 70. The next one is 40. And the next one is 50. Right? So 50. So what is the cumulative cash flow? Okay. So this will be 200,000 negative. Now, if I invest 200,000 and the investment gives me back 80,000, please, how much is left for the investment to pay me back? Negative. Now, once it is left for the investment to pay me back, and the investment is 70,000, what is left for the investment to pay me back? 50, Abby. People should respond. Let me know that you are with me. Unless, okay. Now, the investment has 50,000 to pay me back, but it has paid me 40,000. What is left?
10,000.
10,000 negative. Now, the investment has 10,000 to pay me back. It paid me 50,000. What is left? He has nothing left. So
40 positive.
This is where I start making profit. So any point that you get to positive, you stop. Even if this project goes to 6, let's mute. So even if we have year 5 and year 6, and let us say year is let's say year is 60,000. Okay, let's say year is 59,000. Okay, as long as we have gotten to a positive figure here, every other thing here does not matter. Does not matter. That is why I said, if I can give you up to 10 years, it doesn't really matter. The moment you get to a positive figure for your cumulative cash flow, you are done. You are just done. That is all. So how many years do we have? Can anybody tell me how many years to get pay back the 200,000 you have invested? Can anybody tell me?
4 years.
4 years.
4 years.
4 years. Who agreed? Who is agreeing with her? How did you get 4 years, madam?
Okay, I think it's 3 years. It's 3 years.
3 years.
The last 10,000 was paid in the 3rd year.
Is it not 2 years?
2 years.
Yeah.
Jesus.
It's 3 years.
3 years. Hallelujah. Any man?
6.5 and half.
Any man here?
Sir, it's 3 years.
As at the third, the last 10,000 was paid in the third years, and the fourth year we started making profits.
What paid the last
Sir, it is 3 years and plus some months.
few? It is 3 years plus some months.
Okay.
Please, let's mute. Let's mute. Help me, please. Help me. Help me. So how do we get 3 years? Ignore this year 0. Start counting the ones that have brackets. So this is 1, this is 2, and this is 3. That gave us the 3 years. This 10,000 was recovered in year 4 because year 4 was having 50,000, but now it is left with 40,000. It means that it has paid for 10,000 in year 4. So we need to look for the proportion of 10,000 inside this 50,000 that paid it. So that would now be 3 years plus 10,000 that we need to complete the money divided by who is paying for it. 50,000 is paying for it. Then multiply it by, because we want to represent it in months, so you can say times 12 months. If you want to represent it in days, you can say times 365 days. Anyone works. So can somebody do this for me? 10,000 divided by 50 times 12. That will give us the exact months that is going to take us to pay this money. 10 divided by 50 times 12. Problem.
So please, can I ask a question?
Give me figure first.
0.6
Let's do figure first. 2 point what?
times 12.
Yes, times 12. 2.4.
Yeah, that is 2.4.
2.4. So this is technically around 2 months. 2 months plus. Are you getting it now? 2 months plus. So 3 years and 2 months. If this is 5, I would have just said it is 3 months. If this is 6, I would have said this is 3 months directly. So it took us around 3 years, 2 months and some days to recover this 200,000 naira that we have invested. Now, that lady with the beautiful voice.
Okay, sir, please, the 50,000, is it because we started at year 4? Is that why we're actually using 50,000 to do the division for the 10,000 in negative? Please, I just wanted to be clear on that. Thank you.
The 50,000 is this 50,000. I guess now, which was the 50,000 that you paid the 10,000 from? If it was 100,000, would have put 100,000 there. If this figure was 90,000, would have put 90,000 there. So 50,000 is not like it is a fixed amount, or like many courses of the 50,000. No, it is the 50,000 in year 4 that we paid the 10,000 from. So are you getting it now? That is this 50,000 that you see here that we divided it with. So you are going to take the 10,000 that is left and you divide it with the cash flow that will pay for it. Okay, the cash flow that will pay for it, and the cash flow that will pay for it is what? 50,000. I don't know if that is clear. Is it clear?
Yes, it is.
Okay. Any further question, please? Is anybody just doing this for the first time? Let's be sincere. Is anybody just doing this for the first time? Oh, that means everybody has done this thing before now. What am I disturbing myself here? Let me go to where they have not done now.
We've done it before.
People have done it before. You are giving me agbati years, 2 years, 3 years, 4 years. I have done it before. Okay. Payback period that is simple. All right. So what we are going to do now is that we are done with our. How do we? Okay, that's where we are now. What's the decision rule? Who can tell me the decision rule? If you have done it before, who can explain the decision rule guiding payback period?
Adopt
I think
the project if the number of years is shorter.
Compared to what? How do you
compared
make
to the expected number of years.
Thank you. All right. So when you want to make your decision rule for payback period, consider 2 things as a professional, right? Are you evaluating one project? Or are you evaluating mutually exclusive project? Let's say more than one project. Okay, more than one. More than one project. I want to speak like professionals. So let's not just talk like the way other people talk. That is why you're in Pathfinder. For one project, Abi, they only gave you one project to evaluate it. So let us assume that the answer you got is 5 years. Now you need a benchmark. You need something to compare this figure against. So what is that thing you're going to compare this figure against? You're going to compare this figure against any. It's not a figure like the years, the answer you got. You're going to compare it against any year that I can give to you in the question as management's what intended payback period. So if management are saying that, look, if we give you money, we want our money within 3 years, or we want the project to give us our money within 4 years. So imagine the managers are looking for 4 years, but after you have completed, you got 5 years. What does that mean? We can't go ahead because the project is taking too much time compared to what the managers are expecting. But if it is the other way around, okay, managers are looking at 5 years, but the project is giving us 4 years. Good business, man. Good business. We are going for that project immediately. And that's what we do. But if it is more than one project, so let's say we have project A, project B, and project C. It means that the company can only take one of these projects, just one. Which one are they going to pick? They'll pick the one with the shorter payback period. That's how you evaluate payback period. That's how you make decisions for payback period. Does that make sense? Does that make sense? Now, payback period, I have not seen in my full experience in finance where any CFO makes use of payback period as the only means for evaluating a project. I've never seen, but if you have seen, please let me know. So what happens in real life is that nobody does project evaluation using payback period only. So what they do is that they will match your payback period with another investment appraisal technique. Okay, they're going to merge it with another investment appraisal technique and then use it to appraise a project. But say I want to appraise a project using payback period, they don't do that. Okay? They don't do that. Maybe at shallow level finance, maybe they can do that. But where you are investing huge amounts of capital, billions, you can't just say payback period for work. Okay, so that is it, and that is it. All right. So the next one we'll be looking at is our discounted method. Before I move to discounted method, do you have any question for these two guys that we have done? For these two guys that we have done, do you have any question at all? Any question at all? Any question at all? Silent means no question. That's fine. So let me explain what your modern discounting cash flow method means. I will take just two. I will take your NPV and IRR. Then maybe next I will take these other parts, okay, and treat those ones next. Trust me, all without knowing MIRR. It's not possible. It's not possible. This guy can be as much as 10 marks, so it's not possible. So I'm going to address the MIRA, okay, which we call the MIRR, maybe in a subsequent class. But let's take MPV and IRR. MPV. Now, the MPV simply means the net present value. Okay, the net present value. Good news. When I can tell students and say evaluate this project without I can stating the method, there's a 95% probability that that question is an MPV. Nothing you want to tell me. That is the most tested investment appraiser technique in SFM. The most tested. Oba. Am I making sense now? So please, you have to think that this. So we're looking at net present value. Okay. So under this thing, we are looking at two things. We're looking at the present value of inflows and the present value of outflows. Okay, so when you subtract, okay, that is what now gives you the word net of the present values. Am I making sense now? That is what gives you the net of the present values, right? So your inflow, you are going to bring it to present value. Your outflow, you're going to bring it to present value, and then you subtract to get your net present value. Can you hear me clearly? Because I want to say something clearly. Can you hear me clearly?
It's clear, sir.
Present value means current price, current value, today's value, today's price. Am I making sense? It's present value. Present value is the opposite, okay, of future value. So let's make good comparison. So I'm going to put present value here. I'm going to put future value here. Come and work for me, right? Come and work for me. Or let's take an example. Okay, your father left inheritance, right? If you can wait till 2 years' time, okay, if you can wait till 2 years' time, the inheritance will amount to $15 million. But Gary has blind your eye. You cannot wait till 2 years' time. You now say, if I want to collect now, so how much will I collect? And that's okay. If you want to collect it now, you collect $10 million. So that's the good way to explain future value and present value. Future value means what something will worth in the future. Okay? And present value means how much does it worth? So that's present value. Okay, that is present.
Sir, we can't hear you clearly. We can't hear you clearly, sir. Can't hear you.
Where did you stop? Where did you hear me to?
So I heard you when you said PV means blah blah blah. The other things you were saying, we can't hear you. Your line went
Present
off.
value means current price. Current value. Can you hear me now? Current price. Current value. Today's value. Today's price is the same thing. Did you get that point? That's the problem I have. But the moment
Yes,
you don't
sir.
hear me,
Yes,
you will
sir.
shout. But now I'm trying to communicate. You will not answer.
Yes, sir. Yes, sir.
You said we
Yes,
should
sir. Yes,
mute
sir.
now. So once we ask the question,
Yes.
we'll mute. Yes, sir. We can hear. I can hear you.
Then I said PV, which is present value, is the opposite of future value. Did you understand this one now? Good. And I said, let's compare PV and future value. Let's explain it in simple terms. Your father left an investment. If you can wait 5 years' time, or if you can wait 2 years' time, the investment will be ripe and you will go home with $15 million. Did you hear me now? But if you cannot wait till 2 years' time and you want to collect the money today as we are speaking, you can only collect $10 million. So that $15 million you are going to collect 2 years' time is what we call future value. The $10 million you are collecting now is what we call present value. Does that make sense?
Okay, sir.
Yes, sir. Okay, sir.
All right. Now, the next thing you need to understand is that you have a formula that you would use to convert future value to present value. Okay? That formula is what we call your discounting factor. The formula used to convert, okay, future value to what? Present value is equals to what? Your discounting factor. Okay? So everybody knows the formula, be 1 all over what? 1 plus r raised to power n. This formula is used to convert a future amount to a present amount. So what makes up the formula? The r is your rates and the n is your number of years. So this 1, they are constants, okay? They are constants. It's like 100%. Did you hear me up to this level now? Okay. All right. Now, the formula that you use to convert present value, I will not give you the formula anyways, to future value is known as compounding factor. Since you say you have done it before, you can go and browse it and check it, or call your brain to remind you what the formula is. So for future value to present value, which is what you're going to be doing basically, okay? Basically, there's no point for you doing this because most questions will not come with this. This is what you're going to be doing basically. converting future value to present value by using your discounting factor. So the word discounting factor simply means you're working back. Okay, you're working back because future you're working back to present. But this one present, you're working forward to future. That's how we call it compounding. Compounding is like you're working forward. Discounting is like you're working. Did you get it up to this level? Did you get it? Okay. So that is it. That is it. That is it. So what's the next thing we're going to be looking at under MPV is your decision rule. I mean, your decision rule. So who can tell me what's the decision rule for MPV? What's the decision rule for MPV? What's the decision rule for MPV?
Accept positive and
Accept what? Positive MPV. If the MPV is positive, accept it. When you have more than 2 projects, accept the project that has the highest positive MPV. That's simple as that. Okay? Accept the project that has the highest positive MPV. Does that make sense? Does that make sense, please? Does that make sense, please?
That's it.
Does that make sense, please? Does that make sense, please?
Yes, sir.
Oh yeah, no wahala. Okay, that is all. Oh, that is all. Let's take this question, even if we know they cannot set it for you. Let's just use it to have an understanding of MPV. Can you hear me? So, Adewale Limited
Yes,
is a capital investment where the estimated cash flows are the years and the cash flow. So, this is the cash flow, and this is the years. Okay. And I said the company's cost of capital is 15%. What is the MPV of the project and should it be undertaken? Let's just use this question to play. Okay, let's use it to play. If you want to calculate MPV, use your tabular method. Yeah, we have the formula, we have the tabular. Nobody uses the formula, right? Nobody wants to put formula in their head. Everybody wants to use the tabular method, but definitely we have the formula and tabular method. Just put the yes. Are we going to put those that have done it before? Oh yeah, now people are not proud of it.
So we are not hearing you again.
If I used to ask
I'm
question,
not hearing you.
you are not hearing me when I ask you question. Abi,
No, it's like before then we're not hearing you.
can you
So
hear
we
me?
didn't even hear when you asked us the question.
Can you hear me now?
It's faint, very faint.
Should I cancel my class? Maybe we'll wait until I get to my.
No.
No, boss, it's
No,
network. Oh, it will be stable.
no.
No, sir, but I'm thinking it's the network.
Even me, I don't know whether it's network or something. It is not the network. And that is the reason why we have another system. But there's break. They didn't open till next week Tuesday. So we'll check and see how we can go about it. If you can manage with me. The video is already on your platform, right? Complete set of video for your investment appraisal is already there. And it is clear, right? So you can actually watch it there. What I'm doing is to fulfill all right customers. Like we never did this diet, so it was just a video. I don't want that to happen. I'm taking it again. Okay, so everything you need to know on investment appraisal has been analyzed, presented, and taught on the platform. So we are just trying to do like fulfill all right. But just bear with me, but let me know if I'm low, and then I'll come back. So now I'm asking this question, we want to solve it. Can you hear me now? This question, we want to solve it. So it's a very simple question. And I said that there are 2 ways to solve it. You use your tabular method or you use your formula method. Nobody uses formula method because they're lazy. Nobody wants to start with it. So what do? We use tabular method. Okay? We use tabular what? Method. Are we good? We use tabular method. So this is how we go about it. Our yes. Can you hear me, please? Our yes. Can you hear me, please?
Yes,
Yeah.
yes, sir.
Our yes, our cash flow. After cash flow, what is the next thing?
Discount factor.
Discount factor. What did I say you use discount factor to do?
to convert from future to
Convert from future value to present value.
That is it. That is it. Then after discount factor, what do you have?
Present value.
It's true. You people voice too is cracking. No? That means it's two ways, Abby.
Apparently.
I think it's two ways now. Your voice is skipping. It's not me. Okay. MTN, you are in soup. All right. So we have the years, right? So if you look at the years, we have year 0, which they call that is now. Then we have from year 1 to year 4. So let's go 0, 1, 2, 3, and what? 4. Are we good? Year 0, we incurred 100,000 naira. So put it there. Those are your cash flow. Please, this cash flow in the question, are they present value cash flows or future value? You can tell me.
Future.
Thank you. They are all future values. It means the amount you're going to receive in those years. So that is why you need your discount factor formula to bring them to present values. So all these cash flows are future values. So how do we use the discount factor formula to push these figures to present value? That's what we need to know now. So what's the formula? 1 over 1 plus
1 plus
plus R and what's for N.
So this one will still be 100,000. Oh, sorry. What will be there? What will be there?
1.
1, thank you. So here will be 100,000. I've done it before. Where are they?
The next one is 0.86.
0.86.
8696.
Okay.
0.8696.
Okay, thank you. So what is already say Jesus? How did they get that figure? Oh God, who is this guy? 8696. They will swear for you now. All right, so it's just simply 1 over 1 plus, your rate is 15%. So just do 15 divided by 100.
0.15.
0.15. And close your brackets. Then the end is years. So we're talking about year 1. So put year 1 up. So that's how that guy got 0.8696. No big deal. Are we all good?
Yeah.
So if you are doing for year 2, the only thing you just need to change is this 1 to 2.
0.7561.
0.7561. Just multiply direct. If you get your figure, multiply direct with the 80,000. Any figure you get, just multiply directly with the cash flow.
0.6.
6575.
0.6575.
6575.
75.
Just multiply with 40,000 if you can.
Yeah, 26,300.
The last one is what?
0.5718.
0.5718. Thank you. So you're going to multiply.
The first year is
52176.
52176.
52176.
52176. So what should we do from down?
6488.
6488.
Okay.
26,300.
26,300.
Last one,
26, not 27. 26.
The last one, 17152.
17154.
No,
So the one before that one is 26,300, not
the one
27.
before, not 27.
This one
The last one is 17,153.
17,154.
17,153.
54.
153.
4.
It doesn't matter. It doesn't matter.
To give us
I will not fail you.
positive 56,188.
56? It's not possible. Positive what, sir? Madam.
56110.
56110. So this is our NTV. So what she did was to add up all these
56,118.
Thank you very much. So is it clear? So this is a positive figure. So you added all these figures and subtracted from the 100,000. So what it means is that we had more money that came in than money that went out. So that's why our NPV is positive, 56,118. And that means that we should go ahead with the project. Does that make sense? It's not a big deal. Okay. NPV at this level is not a big deal. But when we start doing the big boy, that is when you now begin to enjoy NPV. Okay, you need to enjoy NPV. So that is that. So the next thing I want to look at is the IRR, internal rate of return. The internal rate of return. So let's see if we have, okay, that's all we discussed here. Okay, so now the internal rate of return is also known as the break-even rate of return, right? Break-even rate of return. It is that rate of return that makes your inflow to be equal to your outflow. That is why they call it break-even rate of return. So the money that came in, to the money that goes out, that is why we call it what? Break-even rate of return. Now, there is a formula that we use to calculate your IRR. So the beauty about the question is that when ICANN tells you to evaluate a project using NPV, then the B part can now be to determine the internal rate of return. One thing ICANN will not include, they will not say using the interpolation method. It's grammar that they have used. You may not know it as interpolation method, but simply means using the formula method, right? So if you want to calculate your IRR, you have a formula. So who knows that formula?
And higher rate.
Oh yeah. What's the formula?
NPV of lower rate.
Positive
NPV of lower
NPV.
rate.
NPV of what?
Lower
NPV
rate
of
plus
lower rate
NPV of lower rate
rate
Plus
plus
NPV
plus NPV of lower rate all
of
over.
lower rate all over.
What you are saying now, does it make sense? You already said NPV of
now.
lower rate. Then you're not saying plus NPV of lower rate again.
It start with lower
NPV
rate
of lower rate
plus
over NPV
No,
of higher lower rate plus NPV
One
of
else.
no,
higher
it is
rate.
lower rate
NPV
plus
of
NPV of lower rate all
lower
over. NPV of
Plus
lower rate.
NPV of higher
over
rate over higher
NPV of higher
Sir,
It's
Yes.
positive NPV plus whatever they took.
sir, it is lower rate plus
Lower rate
Plus
NPV
NPV
of lower
of
rate
lower rate
All over.
all
over
over
NPV of lower
NPV
rate
of lower
Lower
rate
rate
plus
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 NPV of higher
NPV
rate.
of higher rate
open bracket higher rate
Open
open
minus
bracket
lower.
higher rate
higher
minus
rate
lower rate.
higher
minus
rate
lower rate.
minus lower rate
How many of
minus
Thank you.
how many of you
higher
have
rate
taught in primary school before?
minus higher
See that one.
lower
Mr. Kappa.
rate.
Network has dealt with him. Okay. So I'm waiting for you guys that wants to jot down the formula. So that's just the formula. Sometimes in academics, you feel like you know some things until you are being tested. It's not IRR, it's a simple thing, I know it. But when it comes to for you to now, display that knowledge that you have, that is where you will now know that you had so many lacunas. You have so many things that you don't even know. And that's the reason why school gave tests before they gave exam. They would have gone straight to exam, but they gave you test first, just to see whether you know that thing that you think you know. Unfortunately, not everybody did the mock. And the people that did not do the mock think that they still know something. But in reality, they did not know. And that's how life is. That's how life is. But it's fine. So this is the formula we're going to be using for our IROR. Okay. No more talking about time. Let's dive into solving real questions, big questions, real questions. Let's see what we can do. Okay, before we go to real question, flow with me. Other issues in investment appraisal. Other issues. Let me talk about them now. I'll just list them now, but I'll talk more on them as we proceed. Now, one issue here is taxation. So that is why if you check my videos on the platform, you will see taxation in investment appraisal. I dealt with taxation on its own. Okay, last diet, taxation was dealt on its own. Secondly, we dealt with what? Who can tell me? Inflation. I dealt with inflation in full on its own. That was where we're looking at the money cost of the money cash flow and the what? And the real cash flow. And we look at the money, what cost of capital, and the what real cost of capital. Jot this thing down, you will tell me later. Number 3, we look at the working capital. Working capital in investment appraisal. Working capital in investment appraisal. Okay? Working capital in investment appraisal. Truth be told, these are the 3 basic champions that I can use to frustrate you in MPV. These 3 things can frustrate a student in MPV. Any other thing can now be, number 4, leases in investment appraisal. Leases or buyback or buy in investment appraisal. Okay, in investment appraisal. In some textbook, leases are treated. If you take the way the question comes, it has this investment appraisal vibes. So we have to treat it like it is part of investment appraisal, issues that we can address, right? Then you have again, what do we have again? We have the likes of the big guys, sensitivity analysis. Sensitivity analysis. Please jot this down. And we address all with questions. You see sensitivity analysis. In textbook, in your material, you will see it under risk and uncertainty. But if you check the way the question is being structured, it has also investment appraisal vibes. Therefore, we categorize it as like an issue to be addressed under investment appraisal. Am I making sense, please? Am I making sense? Am I making sense? All right. If I'm not making sense, I should make sense here. Capital rationing. Capital rationing. I know you guys have done this. Your lecturer must have taught you. That's fine. Now, you see capital rationing, it's a standalone topic. Standalone. This guy took pages in your material, in your textbook, or in your study pack. But the way the question is tested, sir, it is capital appraisal question that they now chip in capital rationing. You understand? So it is part of the issues that we're going to be addressing under investment appraisal. Then we can now look at other things like our, where are they? Like our, profitability index, our MIRR, and our, what do you call it, discounted payback period. We can now look at all those ones later, but I know MIRR is more examined. Sometimes you may not even see discounted payback period, but we just have to just cover it for, for in case it just for anything can happen. Anything can happen. So these are the other issues that we're going to be looking at. But before that, let's leave that and take some questions. Let's take some questions. Let's see. Okay. Okay, hold on. Okay. Okay, let's start from here. Let's start from here. So questions and solution. Okay. All right, so what we'll do is that somebody this is the first question. Just read it up to this place and I will solve. And I want to take the second question. You read it up to this place, I will solve. For every question that we are taking, you are learning something new inside. So that when you now take a full-fledged question, okay, a full-fledged question, handling those questions will be very, very, very easy. So who is going with question number 1? I'll provide solution. You just read for me. That's the only thing I need from you. Who is reading number 1? Is it not clear? Can't you see? Oh my God. Can't you see the screen?
A project costs 40,000 to initiate and is expected to have a useful life of 10 years. It will generate annual profits of 4,000 after charging all expenses, including depreciation at 10% per annum on costs. Calculate the payback period.
I love that person's voice. Very nice. That person is still on the call with me. A project costs 40,000. What does this 40,000 mean? What do we call it? That same person.
The cost of
Initial outlay.
Initial outlay or cost of investment. Thank you. All right. Cost of investment or initial outlay. All right. And it's expected to have a useful life of 10 years. So the project will last for 10 years. That's the useful life of the project. It generates annual profit of 4,000 after charging all expenses, including depreciation. Is this money, this 4,000, is it profit or cash flow? Who can explain for me?
It's cash flow.
Okay, further explanation.
cash flow.
After charging all expenses, including depreciation, then it should be net profit now because depreciation
It's
has been
net
removed
profit
already.
because depreciation has been added.
Net profit has been removed.
Has been removed. That is the word. So because depreciation has been removed, please, the 4,000 is net profits. Net profits. Good. And they said, include depreciation of how many percent? 10% per annum on cost. What is the cost?
It's 40,000.
God bless you. They said calculate the payback period. Now, when I was talking about payback period, right, I told you that we have two areas to address in payback period. What are they? Even and uneven. Is this one even or is this one uneven?
Even.
Can you hear me? Is it even or uneven? And why?
Even.
Why?
It is
You didn't give us
it
a
is it
difference.
is even. It is even because the net profit
Yeah,
is generated annually, the same amount every year.
they fixed.
That is just the answer to it. So it is even because you have an annual profit of 4,000. Okay? And it's also to calculate our payback period. When calculating payback period, do we use profits or cash flow?
Profits.
Profits.
That person that said profits,
flow.
I'm not sure you have brushed today.
We use cash flow.
We use cash flow. Which
Profits.
method do we use profits?
Is there
Yeah.
Sorry.
Oh,
Sorry.
You know, follow. So since you agree with me that we'll use cash flow, so what do we do to these profits? Guide me thoroughly. What do we do to these profits? So we have the
we'll
profits.
convert it to cash flow.
Thank you. Oh yeah, guide me. I'm with you.
Yes, by adding the
4,000.
depreciation back to it.
Okay, depreciation should be added back. 10% of what?
Yes, sir. To make it 40,000.
40,000. Figure me. That's 4,000.
That's 4,000.
So if you add both, what's now our figure? So these are what? Annual cash flow. Somebody tell me you don't understand. Can somebody say I don't understand? Right. So that means everybody understood. So now that we have cash flow, then let's solve our payback period.
Sorry, I don't understand. Sorry,
Sir,
sorry, I don't
not that
understand.
I don't understand, but can you explain why we are adding the depreciation to profit to get our
I
cash
don't
flow?
understand. Please explain. Please.
Okay, the two persons that are saying they don't understand, is it that you were not with me from the beginning of the class? You just joined? Let's know so I will know the depth of what I'm explaining.
Sir, not quite long.
Not quite long I joined.
30 minutes ago. 30 minutes ago I joined.
You joined 30 minutes ago. Hallelujah. The power that comes with lateness is so strong. It can affect anything in the future. Please, don't be late to success.
Sorry.
Don't be late. It's not me. Me, I'm chatting.
Sorry.
It's you.
Sorry, don't be annoyed. Sorry.
Now, who can explain what we did here? Anybody that joined us from the beginning? You know, sometimes you can meet us from the beginning, but you don't understand anything. So I'm only talking to people that were with me from the beginning, but still understand something. Why are we doing profit to cash flow? Just tell us something that they can understand. Anybody? I don't understand.
We have to add back our depreciation to get the cash flow. So that's what we did.
They know now, but they want to know why. Why are we doing that? Like, tell them what is profit, what is cash flow, and why are we adding up.
Okay, let me come in here. Payback period can only be calculated on cash flow, not profit. So if profit is given to you, you have to add back the depreciation back to it to get the cash flow in order to calculate your payback period. So
yes.
So what
Sorry, to add also, it's not just depreciation. It depends on whatever we are giving. If it's provisions, if it's notional costs,
okay,
just non-cash transactions.
Non-cash transactions, yes.
See, there's a job vacancy in Unilag for lecturing. So I don't know, both of you can apply. The pay is good, 1.6 million. I don't know if you are interested, because you just did justice to it. So those two persons that are asking, I don't think you have any other question. Is it not clear?
Yes, sir, it's clear.
These people have gone. These people go and apply for the job. Leave where you are working now. Go and apply for that job. Go and lecture, please. It's good. Thank you. Thank you. Right. So since we have our cash flow, give me the formula for payback period now. Initial outlay, Abi, or even. You know, it's even we are calculating. Then divided by what?
Cash
by
flow.
what? Cash flow. Thank you. That is our annual cash flow every year. What's our initial outlay in this question? Who can tell me?
40,000.
40,000. There's nothing to even talk about. What's your cash flow? Your annual cash flow?
8,000.
8,000. Help me divide. What did you get?
5
5.
years.
So that 5 is not 5 naira. It's 5 years. Any question? Just respond. I know we have a lot. Just help me. We have a lot. So any question? No, yes. Let's move on. See, we are good.
Sir.
We are good, Abi. Oh, yeah, no. Oh, yeah, no problem. Now, somebody take example. This first one. Another angelic voice. Take that. Just read it.
A project requires.
Please, that man, don't say anything. Your voice is too. Madam, go ahead.
A project requires an outlay of 100,000 naira at the beginning of year 1, an additional 131,250 at the beginning of year 2. Labor and other production costs are expected to amount to 25,000 naira per annum from year 1 to year 10. Sales revenue of 87,500 naira is expected at the beginning of year 4, and this will be received for 10 years, the same amount per annum. Calculate the payback period.
All right, thank you. Stay with me. You direct. Stay with me. The project requires an outlay of 100,000. What is this 100,000 called? What
initial outlay.
Initial outlay.
Initial outlay.
Yes. At the beginning of the year. Be very careful. All right, be very careful. I will come there, but not now. Let's mention it. The word at the beginning of the year is a strong word in capital budgeting. There's difference between at the beginning of the year and at the end of the year. But everything remains silent for now. When I start dealing with your complex investment appraisal question, we will read meaning to every sentence used in that question, and we'll do justice to it. But just bear in mind, some wordings should not be taken for granted. Beginning of the year, end of the year. No challenge. All right. at the beginning of the year, at the beginning of year one. Okay, let me just explain it here. Makes sense. Now look at it here. Look at it. I said a project requires an outlay of 100,000 naira at the beginning of year one. Okay. Now, if you look at this project, it's going to last for 10 years. Let's do a graph, or let's do a timeline for you for it. Watch me. This is very important. As important as your ACA certificate. Please. This is 0. This is 1. This is 2. Number line. Now you know it's 3, 4. Let's stop in 5. It will go all down to 10. Watch me. The project should start from year 0, the year that you invested money. The first year that you invested money, the project should be called year 0. And please, try to test on your understanding.
Sir, your network is cracking.
The last thing we heard is watch me.
If I ask you a question now, you will not answer.
Yeah, you're back.
As it's cracking now, you shout. I'm back. Can you hear me now?
Yes, please.
Yes, sir.
Yes, sir.
This is number line. Watch me. Did you get this number line that I drew? I drew a number line to explain the years of this project.
Yes, sir.
Okay. All right. Now what? Now, I said that for any project, a project should start from year 0 because that is the year that you invested money in that project. Did you get that? Usually in year 0, you only spend money. Usually, you only spend money. But there's a situation where you can still receive money in that same year that you spend money. But all things being equal, you spend money in year 0. And from year 1 going forward, you are to be receiving money from your investment in year 0. Did you hear me up to this level now? Did you hear me up to this level now?
No, sir. It's cracking.
Hear me and hear me clearly. Hear me well. Hear me with the Holy Spirit of God in you. Please. Investments usually start from year 0. Which means that year 0 is the year that you are investing money, all things being equal. From year 1 going forward, you are expected to be receiving money from that investment. But look at this question. The question says that a project requires an outlay. That is to say, you want to spend money at the beginning of year 1. From looking at this thing, it means that you jump year 0 and came to year 1. You know, year 1, we have beginning and end. The beginning and the end. Please, did you hear me up to this level? Did you hear me up to this level?
Yes, we hear.
Good. Good. Thank you very much for that. So they said that you are going to spend 100,000 naira. Can you hear me now? Give me voice text.
Yes.
So they said that we are going to spend 100,000 naira at the beginning of year 1. Jot it down with the last 10 that you have. The beginning of a year is seen as last year. The beginning of a year is seen as what? Last year in investment appraisal. Because it is assumed. Can you hear me? Yes, I'm recording. Because it is assumed that in investment appraisal, cash flows only come in as at the end of the year. Do you hear me up to this level? Is my voice clear?
Yes, sir.
Good.
Yes, sir.
So anytime, anywhere, I can say the revenue came in at the beginning of year 3. That as they just say beginning of year 3, your mind should be into year 2. That is when the money came in. So any money received at the beginning of the year to be taken for the previous year. So this 100,000 that the question said at the beginning of year 1, it simply means that the 100,000 was at what? Year 0. It's just a trick to take you out your feet. Okay? Just a trick to take you off your feet. So until you understand this concept, you will not pass this thing. So are we good with this now? So this beginning of year 1 is the same as what? Year what? 0. Is it clear?
Yes, sir.
But if they say the end of year 1, if they say the end of year 1 is still the same thing as year 1. Okay, if they say the end of year 1 is still the same thing as year 1. If they say the end of year 2 is the same as year 2. But if they say beginning of year 2, okay, take it to year 1. Beginning of year 3, take it to year 2. That is the trick there. Please take note of that. All right, so we are going to incur 100K here, 100K here. And I said, and additional 131.50 at the beginning of year 2. Who can interpret that for us?
You say?
Who can interpret this for us? And additional 131.50 at the beginning of year 2. Who can interpret it for us now?
So he's saying that,
That
sir, that beginning of year 2 is the end of year 1.
It means 131,250 was also incurred in that year 1.
The word was also incurred. No, was incurred in year 1, not in year 2.
Okay.
So I
Yes, in year 1.
131 what? 250. You know their outflow. So you are not seeing a question where outflow is not taking place in more than 1 year. Are you seeing a question like that now? Then I said labor and other production costs are expected to amount to how much? 25,000 per annum from year 1 to 10. So labor cost, okay? Labor cost and what again? Labor and other production costs. You are going to be spending 25,000 naira from year 1 to year 10, which is also an outflow, Abi. All through from year 1 down to year 10. You spend 25K annually. Okay, annually. Sales revenue of 87,500 is expected at the beginning of year 4. Okay, it therefore means that the sales revenue will start from where?
From year 3.
So you start making money from year 3. How much is it?
Yes.
87,000.
87,500 naira.
Thank you. So that is your revenue. That's your sales revenue. That's not your profit. That's not your cash flow. That's your revenue. So they say at the beginning of year 4. And this will be received for 10 years. This will be received for 10 years, the same amount per annum. So the same amount going forward. Okay, that's what you're going to be what? Receiving. And I said, calculate the payback period. You see, as simple as payback period, look at this kind of question now. It may pose a threat to even a professional student to solve. But let's deal with it. Solution. That's question 2, Abi. Question 2. Okay. Let's deal with it using the tabular method. It makes more sense. Okay. I think that's what they did here. So let's put item to explain what we are doing, and then the years, okay, and then the cash flow, and then the cumulative cash flow. All right. So how many years is this project? This project is for 10 years. But don't put your 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 at once, because it's kind of complicated. All right. So let's analyze it one after the other. First and foremost, in year 0, we spent 100K. So let's start with that. So from year 0, okay, we spent 100K, and that was our capital outlay. 100K. Put it in brackets. Put it in brackets. Please, can you still hear me? Can you still hear me, Abi? Okay.
Yes, boss.
Yes, sir.
Okay. Then in year 1, okay, we spent 131,250. So let's take it there and say further outlay or further cash outlay. Further outlay. Which was in what? Year 1. We spent what? 131,250. Let's take it small, slow. Does it make sense now? Okay.
Yes, sir.
Then, yes. Now, what again did they say you will do? Now, from year 1 down to year 10, you will spend 25,000 naira. Maybe?
Yes, boss.
And that 25,000 naira is for what? Who can tell me?
They said production and labor cost.
Thank you. So, labor costs. Labor. Year 1, I can say labor year 2, labor year 3, labor year 4, down to year 10. But let us be more smart. Okay, let us be smart. Let's be smart. So labor year 1, labor year 2. Okay, how much is it? 25,000 and 25,000. It's an outlay. Okay. Now, from year 3, we started making revenue. Abi? So I will call here net inflow. Why am I calling it year inflow? I'll start from year 3. What is happening is that how much do we make in year 3? Every year, 87,500, Abi. So I can say 87,500, Abi, minus what? Labor cost inside. Isn't it, Abi? That will give us the actual figure. What's the actual figure? Do 87,500 minus 25,000.
62,500.
62,500. You see it now? So that's what's going to happen for net inflow for year 4, net inflow for year 5, net inflow for year 6, net inflow for year 7. If I do it to year 10, but you may not need everything, to year 9, and finally towards to year 10. The same amount, because you will incur labor costs of 25,000 naira every year, and you receive inflow of 87,500 every year. And your inflow will start from year 3. That is why we started this calculation from year 3. Inflow minus labor cost is what? Outflow. So everything will be 62,500, 62,500. It's positive, but your income is more. 62,500, 62,500, 62,500. Okay, just do everything down. You don't necessarily need everything, but this is a practice class. All right, so we are good. Please, is anybody confused up to this level? Are we good up to this level?
Yes, boss.
Thank you very much, sir. Now let's go to our cumulative cash flow. So start with the 100K. 100, bracket it. So this is minus minus. That means you are plussing. So help me do 100,000 plus 131,250. What are we going to get?
231,250.
231,250. Negative. So let me add it again to 25,000. Egoni.
256,250.
256,250. Help me add it to 25,000 again.
281,250.
281,250. Thank you. Now start reducing it with the positive figures. 281,250 minus 62,500. What do you have left?
218,750.
218,750.
750. It's still negative. Reduce it again.
156,250.
250.
Negative.
156,250.
Yes.
Yes.
Okay, reduce it again. We'll continue.
93,750.
93,750.
90 what?
93,750.
93,750.
Continue.
Now we have
31,250.
81,250.
31,250.
Continue.
Now we have 31,250 positive.
31,250 positive.
Yes.
You see, all this one here now, they are useless. They don't matter. Okay? They don't matter. Who can tell me the payback period?
So
6 years and some months. Abi? Yeah.
6 years. Okay, let's go. 1,
And
2,
some
3,
months.
4, 5, 6. I don't know what you are saying. Why do you tell me 6 years? Person have shut up.
It's 7 years actually.
Are we supposed to count the like outlay and the expense because that was what you did? Is it
What
not
are we
supposed
supposed to
to?
do? Don't look at what they did in their own. Oh. Don't look at what they did in their own. Oh. You tell me what you feel like.
I
Tell me
feel
what.
like we're not supposed to count by the expense and the income or whatever it is. We're supposed to just count by the number of years.
Okay, good. So that means that
Like
this one is
for
1
example
year.
now
Does that
is
make sense?
like it happened in year one irrespective.
Thank you very much. So this is 1 year. So this is 1, 2, 3, 4, 5, and what? 6. Is it clear now? So that's going to be
Yeah, 6
6
months.
years. And what? Who can tell me how I get my fraction?
6 months.
It's gonna be 31,250 over
31
31 to 50
over what?
62,500.
62,500.
500. Now put it in months, yeah? So that'll
That'll
be
be 0.5 times 12.
6
That's
years,
6 months.
6 years, 6
6 years,
months.
6 months. Yes.
6 months, yes.
Okay, any question? Any question?
So what's like the decision rule here? They did not ask us
They
for
didn't give
decision.
us they didn't give us what management is expecting. So we are not supposed to make any decision. So it is just 6 years, 6 months. But if they have told us that management are expecting a project of within 5 years, it therefore means that this project is not viable. Because management are expecting their money back in 5 years, and you are talking about 6 years, 6 months. Who cares? Nobody cares about it. But when you're only 6 years, 6 months, and management is expecting like 7 months or 7 years or 8 years, then your own should fly. Does that make sense? All right, ladies and gentlemen, that is wonderful. Let's go down and see what we have. Okay. So let somebody read this and stop here. We want to calculate the ARR. That's our question 3. ARR. Please.
Femi Limited.
Okay.
Femi Limited is considering the purchase of a new machine, which is expected to save labor on an existing project. The cash flows associated with the project are as follows. Initial cost 0, 120,000. Residual value of the machine year 5, 20,000. Annual labor cost savings year 1, 40,000. Year 2, 40,000. Year 3, 40,000. Year 4, 20,000. Year 5, 20,000. Calculate the ARR.
Stay with me. Thank you. Stay with me. All right, stay with me. Now, the firm limited is continuing to purchase a new machine, which is expected to save labor on an existing project. The cash flows associated with the project are as follows. So this is your initial cost. It means that we are spending 120,000 naira on the machine. Okay? The residual value is the same thing as scrap value. Okay, scrap value. Scrap value. Now, what that means is that this is going to be how much the machine is going to be sold, or how much you're going to realize from the machine when you sell it, right? That's 20K. And I said annual labor cost savings. I need you to explain this part. What do you mean by annual labor cost savings? That is where I want you to explain for me. Please go ahead. Is it that the person did not hear? Is the person confused? Is life not fair? I don't understand. Here's the challenge.
Let me try.
Oh yeah, go ahead.
I feel like cost savings is an inflow and it's it's supposed, just like the name implies, it's supposed to be the savings that you get based off the costs that you have incurred on labor.
Mochi Bades. Thank you. All right. Who again?
The word savings automatically amount to it being an inflow. So we won't deduct it. We have to add it up.
All right. Two giant.
Can I try?
Okay, go ahead.
So I feel like it's like the amount of money that the company reduces from its expenses after like a 1 year period.
Okay, I didn't get that. The amount of something. I didn't get that. Help me.
I said I feel like it's like the total amount, it's like the money that a company like reduces from its expenses
Okay.
after like a 1 year period.
Okay, good. Okay, the three people that have spoken good and spoken well. Instead of ICANN to just say, or instead of the examiner to just say profits that you got, then I use the word labor cost savings. It's the same thing. The same thing. So you are getting money. That's what it means. Okay, but the money was actually gotten as a result of what? Maybe decrement in labor cost. That's why they call it labor cost savings. Okay. So year one, you get money 40,000, year two, 40,000, year three, 40,000, then 4 and 5 is 20,000. Then you are now told to calculate the ARR. Okay. All right. So this is a very simple question. If they bring this in your exam, just hiss. But this can only happen for FM. It cannot happen at professional. Okay. So let's do. What's the formula for ARR? So I said the formula for ARR is what? Net profit, I mean. Over what?
Net profit,
Net profit over capital employed.
So that will be rewritten as average net profit over what? Average capital employed. All right, it's the same thing. Always having the same, but the formula you gave to me before, it did not match. It's the same thing. Depends on the question. All right. So what we're going to do, average net profit before we now average it. Okay. Then we'll get our capital employed first before we now average it. It's just common sense. Okay. So what's our total profits? Get your total profits first. Please add up everything for me here.
$160.
Huh?
160.
160.
Okay, thank you. 160,000. Abi? 1,000 now. Okay, just 160 is 1,000. Sorry.
1,000.
Okay. So now that I've gotten your total net profit, look for the this profit is not accounting. They give us depreciation. Okay. Let's take out depreciation.
Okay. Residual value.
So that depreciation, use straight line. Use straight line. That will be cost, Abi, minus scrap value, Abi, all over expected useful life. What's the cost of the asset? Who can help me? 120,000.
120.
120,000.
Scrap value. 20.
20,000.
What's the useful life?
5 years.
5 years.
What did you get?
That would be 20 years. 20.
Huh?
20.
That would be 20,000.
20,000.
That's 20,000. Okay.
Yes,
Now this 20,000 is depreciation per year. Since we are working with total profit, it therefore means that we're going to get total depreciation. So this 20,000 times 5 years.
That would be
That's
100,000.
100K. So put your 100K here.
Okay.
Now, if you minus it, what do we have? 60,000.
60,000.
Is anybody confused up to this level? So this is what you call your total
No, sir.
accounting profits. Because your ARR makes use of accounting profits. And accounting profit simply means profit after depreciation. All right, so let's look for the average. Average, therefore, means I'm going to divide it by what? 5 years. So that is the years in the question. So yeah, figure me. Ego ne?
That's 12,000, sir.
12,000. So since we have got our average profit, then let's go to getting our average capital employed. So our average capital employed. How did I say you can get your average capital employed? Opening, Abi?
Opening plus closing.
Plus closing.
Plus closing. Then you divide it by what? 2. What's the opening?
So,
what's the opening capital employed? This is where problem is. I've done it before. Where are they?
120,000.
Isn't it? I didn't hear you.
120,000.
120,000. Okay, so 120,000 is opening. What is closing?
20,000.
20,000.
20,000. Now, with what you guys have said, some people are already confused. There's a problem there. If you know you are confused, please speak out.
I am, sir.
You are confused. Is there any man that is confused here? It's normal. It's family challenges.
Yes, but the opening is it the initial? They're using initial and the residual value. Why? For the opening and close. Why, if I may ask?
Because that is what opening and closing actually means in this case.
Okay.
Any other question?
Okay, sir. Okay, sir.
Yeah, so your opening is the amount you invested in the project as at the beginning. The ending is how much the asset worth as at the end of the year, of the 5 year, which is your scrap value. That is what it means. So divide for me, what do you have? 140 divided by 2, what do you have?
70,000, sir.
All right. Then let's bring that into our ARR formula. So our ARR will be what? 12,000. I mean, 12,000. Put it to our average profit. And divide by what?
70,000.
70,000. Then put it in percentage for me. Figure me. What do we have?
17.4.
7.4.
17.14.
14, sir. 14. Yes.
Let's check.
17.14. 17.14.
It's not 14, it's 17.14.
Yes.
Yes, correct. Any question? All right, that makes sense. Okay, let's take another question.
Can you scroll up a bit? Can you scroll down to your calculation sheet?
All right. I will need somebody else to take this question.
AB Limited is considering a capital investment where the estimated cash flows are. We have it on our screen. The company's cost of capital is 16%. What is the NPV of the project? And should it be undertaken?
All right. This question is an insult. It's really an insult. But
Why,
the way
sir?
it is, you say why?
Yes, sir.
This one is primary one work now.
Oh,
it's an insult. It's not really a strong question. So let's just insert them back. DCF. There's one question I'm waiting for. I'm seriously waiting for that question. And that's the next after this. Okay, so our present value. How many years do we have here? 4 years. 0, 1, 2, 3, and 4. What's the cash flow? 30,000 negative.
30,000.
Then the rest is what?
4,000,
4,000,
15,000,
16,000,
10,000.
10,000.
10,000,
18,000.
18,000. Okay, that makes sense. Then this year, Funcom, how do we get this year? Formula is what? 1 over 1 plus r raised to n. So in this case, it's going to be what? 1 over 1 plus, what's our rate? 16%. Please do 16 divided by 100. 0 point what?
0.16.
Close bracket. So let's do for year 1. 1. Here is 1. Oh yeah, figure me. So what should do for year 1? So what should do for year 2?
0.9,
0.8.
0.984.
No. 0.86.
0.862.
So
Okay.
for year 2, 0.743.
Okay.
For year 3, 0.641.
Okay.
And for year 4, 0.552.
Is Sigma in this call? Please help me multiply.
The first year is 3,448.
3448.
Second
The
year
second year
is
is 11,888.
11,888.
11, 11,888.
88. Third year is 6,410.
Third year is what?
6,410.
6410.
The last year is 9,936.
9,936.
Yeah, help me look for the MPV.
Sorry, sir. I want to ask a question.
Go ahead, sir.
Yes. We are doing this year. It's not annuity table.
No, not annuity. DCF table. The normal one.
DCF table.
DCF,
Okay,
the
the
normal
normal
one.
one.
But you will not see it there. Do you see? Do you have it there?
No,
Is
sorry, no
annuity.
annuity.
No, is annuity. Use the normal one.
NPV is
31682.
1682. Positive 1682.
1682. Like
No,
this.
31. Okay, 1682. She's right, sir. 1682.
Okay. Thank you. Any question?
Hello, boss.
Yes, sir.
Yeah, the discounting factor formula, I observed you don't like using 1 plus arrow raised to power of minus n. Is there any reason
It's
behind
still
that?
the same.
Wait.
The 1 over is minus 1 when you convert
I'm
it.
asking if there is any reason.
No,
I know they are the same thing.
There is no special reason. I just feel like some students are much more convenient with that 1 all over 1 plus r raised to power n.
Okay, sir. Thank you, sir.
Sorry, I want to ask that the first year gave us 0.862, which we have in that annuity table. Then the second year was different. So what could be the difference in this calculation, both the table and this?
It's not possible.
The first year is 0.862.
Okay, the first year 0.862. Okay, we are correct. Then the second year, okay.
Second year, 0.743. Okay. 0.64. Okay, it's correct.
Okay.
So when we use the annuity table, I think we'll get the same thing.
So I'm opening this annuity table, okay, because I want to solve a question that requires our annuity. So I'll leave it here. Please, this is going to be given to you, like it's going to be at the back of your question paper. But this is annuity. Okay, this is for annuity. All right. Okay, is there any challenge with this? Should we go ahead with this project or not? I said, and should it be undertaken? So should it be undertaken? And why?
Yes, because it has a positive MPV.
Thank you very much. All right. Welcome to the big board. Take this. Who is reading that for us? Okay.
80,000 naira to initiate. The expected cash flows are year 1 to 5, we have 12,500. Year 6 to 10, we have 10,000 naira. Year 11 to infinity, we have 7,500 naira. If cost of capital is 10%, should the project be accepted?
All right. So this is a very short question, but trust me, if it comes out in an exam, many people will fail it. Woefully, woefully. So let's try it and see whether people will fail it. I have done this topic before. Can you solve it? Yeah, yo. I have done MPV before. Can
Just
we
tell
solve
us what to do. Tell us what to do with the annuity. We'll solve it.
That means you have not done it before.
I mean the infinity, not annuity.
Can you even solve the first two parts, 1 to 5 and 6 to 10? Before you get to infinity. Can you solve those two parts?
Yes, now that one requires annuity table.
You are free. That person that is talking, stay with me. Let's do it. The rest people are shut up. Okay, that's question. That will be our question 5. Let's try. Okay, the thing is that the only thing with this question is that it was grouped from year 1 to 5, from year 6 to 10, okay, and then from 11 to infinity. It was grouped, okay. So you will need your annuity table to do it. Okay, you need your annuity table to do this, but let's try. Let me show you guys what to do. All right. So what do we have? We are also calculating MPV now. It's MPV that we're calculating. They just said the cost of capital should the project be accepted. They don't need to tell you that it's MPV. Looking at this alone, it's MPV. You cannot be saying payback period or ARR. It's MPV. So let's go. Yes. Net cash flow. I mean, then how many percent are discount factor? 10%. Can you still hear me?
Can hear you, sir.
Okay. The way people without do like say, you people are very good actors. Maybe we're not quiet. Like I'm the only one here, but it's good. It's good. So let's go. We 80,000. So we're going to invest in that project 80,000 naira. Then from year 1 to year 5, which is like an annuity, we'll get 12.5. Abi? Then from year 6 to year 10, we'll get 10,000. Then from 11 to infinity, we'll get how much? 7.5. Okay, so now the discount factor that is the main thing. So let's do our workings for discount factor. No big deal. So here 0 is 1. This should be negative. And here should be 80,000. Okay, so what should do for the annuity factor of 1 year 1 to 5? Before I will show you on my screen. The people that have it with them. Do you have it? Okay. Oh yeah, look at it here. Tell me the answer.
3.79.
3.79.
I calculated it also. I don't know. Let's confirm.
You use formula? Did you use formula to calculate?
Yes, correct.
Sorry, did you use formula?
Yes, I use formula to calculate it.
Please, I beg of you. I use God not to beg you. This is much more important than your essay certificate. Apply for the job at Unilag. Okay? It will help you. Okay? To help you. So you can be teaching people these things. All right? Thank you for that. So there's an annuity formula you can use to calculate. But you know, for exam situation, you are in a haste. So just make use of the table. Just make use of the table. So this is 10%. Is what we are looking at. And this is for 5 years, from year 1 to year 5. So for 5 years. So if you do it down, you see it? Say it's 3.791. So let's put it there. So this is going to be 3.79. You can stop in 9, or you add your 1, no problem. So let's do from 6 to 10. Who can do that for me? This is where the problem is. Problem.
4.355.
4.355.
Yes, sir.
Sorry to say. Where did you get it? Is it this one?
Yes, sir.
We're going to do.
No brush today.
We're going to. It is 6.145.
Okay.
Okay.
Then from this 6.145, I think we'll remove maybe 1 to 5 from it or something to get 6 to 10.
You said maybe we'll remove something. I didn't get that part.
Yeah, I said maybe we'll remove 1 to 5 from
1
it.
to 5
Get
from it.
10.
Oh, my students are gurus. Sometimes I ask myself, am I worthy? Am I worthy? Am I worthy to teach you people? I'm not worthy. Excellent. 6.145 minus what? 3.791. Like this, some people are already saying, God have mercy. They are confused. If you are among them, just identify yourself.
I am, sir.
All right.
Me, sir.
Welcome to class. Okay, that's fine. All right, so what she did, what we are looking for is actually, we're calculating on 10%, okay? And we're looking for 6 to 10, okay?
6 to 10.
Yes, 6 to 10 years. There is no way you can get 6 to 10 years on this tip. There's no way. You can either have 1 to 6 or 1 to 10. So what she did was to get 1 to 10, which is how much? 6.14.
6.14.
She now deducted 1 to 5, because if you remove 1 to 5, the remaining one will now be 6 to 10. So what is 1 to 5? 3.91. 3.791. So if you differentiate, if you look for the difference, the answer that you will get is from 6 down to 10. Does it make sense?
Good morning. Good afternoon.
Yes, sir, it does. It makes sense.
Makes sense, Abby. Exactly.
Thank
That's
you,
what
sir.
she has done. So that is, what did she get? What is the answer?
2.354.
2.351. Okay.
No, 54, sir.
Okay, 2.354. Oh yeah, who can do from 11 to infinity? If you get it, I'll give you something. Something nobody has ever given to you at your current age.
Wahala. Okay, sir.
You only have 2 seconds, because I know you people ChatGPT, dangerous people. 1.
Sir, where is the table now? Okay.
I cannot give you more time, because somebody is already asking Google. Going.
Sorry, sir. Please, how did you get this? Hello, please. Network took me away. Hello. Hello, sir.
Go ahead, sir.
This 6 to 10 years. How do you get 2.354? Please.
Just hold on. I will explain. Just hold on. I will explain. Going. 11 to infinity. Going. Gone. Even if I give you 10 minutes without internet, you will not get the answer. If I give you 1 hour without internet, you will not still get the answer. It's me that said it. So let's explain this 2.354 first for somebody. They will come to 11 to infinity. Okay. So for this 2.354, we want to get the discount factor for year 6 to 10. At 10% discount rate. So what we did was to say Okay, what we did was to say from year 1 to 10, at 10% gave us 6.145. Since we are looking for year 6 to 10, let us remove year 1 to 5. So we now remove year 1 to 5 at this same 10%, 3.791. That's how we got this 3.791. So when we subtracted, we now got 2.351. It simply means that the remainder belongs to 6 to 10. 6 to 10 is this answer that we got, which is what we have put here as 2.354, not 3. This is 4, please, not 1. Is it clear now?
Yes, sir. Yes, it's clear.
All right, thank you. 11 to infinity, any person? All right, so it's quite simple. That's why you're in class.
Hello, sir.
Yes, sir, go ahead.
I'm just thinking aloud here, okay? Is it possible for them to skip a year? You know, they gave us 1 to 5, eh?
Okay.
If, for instance, they now give us 7 to 10 without stating that 6, what do we do?
7 to 10. Okay. Do from 1 to 10, Abi?
Yes.
You only need from 7 to 10, Abi?
Yes, 7 to
so
10.
Remove
So
1 to 6.
Okay.
Simple.
Okay.
Remove the ones that you don't want and focus on the one that you want. All right, thank you. So infinity, what's up? The formula for infinity is 1 over r. So we have 1 over, what is our r? 10%, Abi, which is 0.1, Abi. Yeah, divide for me. It's not 10.
It's 10. It's 10.
Are we there? 10.
Yes, sir.
What's the formula for infinity? 1 over r. And our r is 10%, which is 0.1. So 1 divided by 0.1 is what? Is 10. Okay, so we're looking at from 11 upward, right? From 11 upward. That's what we are trying to look at, from 11 upward. So our infinity is 10. So let us remove, okay? Let's remove from 1 to 11, from 1 to 10, sorry. So remove from 1 to 10. Now, what this 10 means is that from 11 going forward, I get it now, from 11 going forward, what are we going to have? Help me subtract first. Do from 1 to 10. We've gotten that before now. 6.145, Abi. This is it.
Yes, sir.
So 3.8.
I'm calling 6.145. What do you get?
3.855. So that's 3.86.
855. Okay, that's 86. Okay. So this is now from 11 to what? To
infinity.
Infinity. Are we good now? Because we are looking at 11 to infinity, right? So first of all, get your infinity formula, 1 over r. Then if you do it, you get 10. Okay? So you have to do from 1 to 10 because you are starting from 11. If it was 12 to infinity, you do from 1 to 11. If it was 15 to infinity, you do from 1 to 14. So that's 1 to 10, which we have checked from here, 1 to 10, which is giving us 6.145. We'll take it out from the 10, right? So the any difference is going to giving us the rates, okay, our discount factor that we are going to be using from 11 till the day that the business expires, till the day that the word end. That's why they call it 11 to infinity. Till we don't know how far, till we don't know how well, we don't know when. Just use 3.86. I beg of you, it is very important because when you are doing business valuation, you will see this thing there. So know this infinity, know how to do it. Know how to do it. So what do we have? 3.86.
3.86.
Oh yeah, now just
950.
the first one is what?
11. Okay.
Yeah,
That's the
just
11th infinity I was giving you.
Yeah.
47,000.
7387.5.
47,000.
387.5.
387.5. That's 386.
The last one is 228.913. 28,913.
Okay. The next one.
23540.
Oh yeah, look for the MPV. Look for the MPV.
Sir, the last one is not correct.
The last one is not correct. So what's the last one?
Yes, 28,950.
It's 28,950.
950.
Okay.
Oh yeah, just look for the MPV for me.
One is supposed to be 388, not 386.
28,950, sir. 28,950.
Sorry, if I may ask, is that 75 or 76?
That's 75.
75.
MPV 1985.
19
positive.
878.
878.
Huh?
9878. Any figure you get is your business. That's the right thing. When you enter your hall, you can't give them wrong figure. People should not come and keep me here with one figure. All right, I'm going to be solving this one. Yes, I'm with you.
Yes,
Okay, so let's solve this one as IRR. They say we should refer to project example 3.04. Calculate the IRR of the project. So example 3.04. Let's look for that. Oh, is this one? Okay. Where do we do that? Let's see. Oh, that's it. Okay, so that's how we should calculate our IRR, Abby. So let's do that.
Yes.
Let's do that. That's question what? 6. Question 6. IRR. Now, you know, when you are calculating IRR, you need two things, Abby. Abby, you need a positive MPV, Abby, and you need a negative MPV. Abby, now?
Yes, sir.
Can you hear me?
Yes,
Can hear you, sir.
Yes,
Okay.
sir. We
Yes,
can
sir.
hear you.
So we have already got our positive MPV. What is our positive MPV? This is it.
19,075.
Abby, and we use 16%, 1682. So let's go.
Okay.
1682. At 20%, 16%. So we need to calculate our negative MPV. Okay, our negative MPV. So let's calculate our negative MPV using the same question. The same thing that we did here. So, okay, this is the question. Let me just do that here. So our years, Abby, our cash flow, Abby, our discount factor, and our present value. Our years. How many years? 4, Abby. 0,
4, yes.
1, 2, 3, and 4. 30,000. Negative. 4,000. 16. 10. 18. All right, so which discount factor are we using?
We can try 35 or 30.
Hallelujah. I like that man. He does not like stress. Just try the highest you can try. Okay, we can try 35. We can try 30. Let's see what they used. Let's see what they used in here. So we can compare. So they use 20. Right, they use 20. So let's try 20 so I can compare answers. Now, it is not necessary that you must use 20, right? You can follow this man's lead. Use 35. The thing is that the final answer will still be the same. If it's not the same, it will be very close to the same. So your examiner will not fail you for it. So let's use 20 here. All right, so the same thing, 1 over 1 plus r raised to n. Whether you are doing the one of minus N, doesn't matter, get the same thing. So what do we get? Here is 1. So here is 30,000. We make use of their own figures since it's already something we know. So we have 0.83. We have 0.69. We have 0.58. On the assumption that their figures are correct, though. Okay.
Yes.
All right. So just help me multiply just to confirm their figures. So yeah, we got 3320. Then if you multiply this, they got 11,040. Then here we have 5,800. It's correct, Abby? We have 8,640. Then what is your MPV? -1, 2. Brackets. MPV is negative. All right, so we've gotten our negative MPV, which is bracket 1,200. At how much? At 20%. So with this information, we can do our IRR. So somebody said lower rate, Abby. Lower rate, Abby. Plus what? MPV.
PV of lower rates.
Of lower rates over
MPV of lower rates.
Plus MPV.
Plus MPV of higher rates.
Okay.
Bracket higher rates minus lower rates.
Okay, thank you. So what's our lower rates here?
15%.
16. Yeah, thank you. 16% plus what's the MPV of our lower rates?
1652. 1682.
1682. 1682. Okay, again, 1682 plus what's the MPV of our higher rates?
12.
12. What's our higher rates?
20%.
20% minus lower rates 16%. Can somebody just do this mathematics? Everything inside here. Yes, 4%. Holy Ghost.
That will be 18. It will be 16% plus 2.33.
No, just do this plus this and do this divided by the answer.
0.5836.
5836.
Yes, sir.
So this is times. So times this guy and plus this guy. What did you get? Just say 0.5836 times 4. Forget about the percent. Just say times 4.
That will be
2.3344.
Plus 16.
Okay.
That will be 18.33. That's 18.3.
Yeah.
Then put your percentage. That's how you do it. It's the same thing with their own 80.2. Very good. We are good, Abby. All right. No time. Now, stay with me. There's a question I want to take now that can be tested in the exam. So let's do this. If we are tired, we can close the class, continue less time. Okay, let's see if we have any question here. All right, let's do this guy. Can someone read this for us?
Okay, Limited.
Yes, go ahead.
OK Limited is considering whether or not to purchase an item of machinery costing 200,000. It would have a life of 4 years, after which it would be sold for 25,000 naira. The machinery would lead to an annual cost savings of 70,000 naira.
Go ahead.
The machinery would attract allowances of 25% on the reducing balance basis. Income tax is payable at the rate of 30% 1 year in arrears. The after-tax cost of capital is 7.5% per annum. Is the project viable?
Hallelujah. All right, this is fine. It's quite good. So let's see what we can do. Please stay with me. It gets more interesting here, and I don't want you to miss out on anything. All right, so in this particular question, what do we have? Consider whether or not to purchase an item of machinery costing 200. Our investment is 200,000, which is very clear. If you have a lifespan of 4 years, it means that the project will last for 4 years. After which it will be sold for 25,000. That is the scrap value. Scrap value. Then the machine would lead to an annual cost savings of 70,000, more or less like you're receiving money. Forget about that grammar. It's an inflow. All right. Then I said that the machinery would attract written down allowance. The machine would attract written down allowance of 25% on the reducing balance basis. So that's like depreciation. So that's like, can you hear me? Can you hear me now?
So you went off for some time.
I know there was a call coming in. I know.
Okay, sir.
Okay. So I said attract written down allowance, Abi. Written down allowance is how many percent? 25%. So that's like the depreciation, right? So depreciation can be calculated in 2 ways: straight line or reducing balance. And you know, reducing balance is the most complicated. So this is our reducing balance, 25% on reducing balance basis. And I told you that income tax is payable at the rate of 30% 1 year in arrears. It therefore means that the tax for 2021 will be 2022, the tax for 2022 will be 2023, as the case may be. Okay. Then they said the after-tax cost of capital is 2.5% per annum. That is what you're going to use to discount. That's a discount rate. Is the project viable? Now, the said is the project viable? The said is the project viable? That tells you that you are doing MPV. Okay, you don't need so much talk. You are doing MPV. So let's look at what we have. I have tax in this question. What do I have again? I have depreciation / capital allowance. Okay, so depreciation is disallowed, right? It's not allowed. We'll replace it with capital allowance because we're making use of cash flow. Don't forget, we're making use of cash flow. So cash flow will disallow depreciation. Don't forget that. Is there any other thing that is in this question again that is complicated? Is there any other thing? After tax cost of capital is discount rates. What again? All right, let's go. There are 2 ways to solve the question. I'm going to give you the 2 ways. And the reason why I'm giving you the 2 ways is because many of you usually read with textbook times. You will say, this is not the way my lecturer did it, or that you still get the same answer. So let us do the 2 ways before you get confused. Am I making sense now? All right, so let's go on. All right, let's see. It's even. Jesus, you make my know. Okay, let's just do it. Let's check the question. How many years is this investment? 4 years, Abi?
4 years.
So I want to teach you something. There's what to call presentation. A student has asked me this question before. So let me say it. Yeah. All what we have been doing here, if you look at it, the years is by this side. Okay? Ladies and gentlemen, good news. When you start solving some kind of complex business investment appraisal, your years cannot be in this side. The one that your years are usually standing like this, vertical. Have you heard you people usually call it? This one that is standing like it is vertical, it will not work. When your investment appraisal question is complex, you will begin to see students bringing their investment appraisal presentation like this. Year 1, year 2, year 3, year 4, and year 5. Am I making sense now? Before you go and say, why is this one? The solution is showing that the years are up. The one that my lecturer has solved, the years are by the side. It's just presentation. And I love this pattern of presentation. This one, as it is one that is horizontal. And the reason why I love it is because it is suitable for complex computation of MPV. Why this one that it is vertical is just for small questions on MPV. So anyhow you want to take it. But we're going to be using the complex pattern because this question is having some Jeku. Anyone can work in any question. Anyone can work in any question, but this one is much more easier. Okay. Let's start. So let's have our outlay. Our outlay is year 0, Abby. Oh, sorry. So let's have our outlay. How much are we spending for this investment? 200K, Abby. Please, can you see?
Yes, sir.
Okay. Thank you. And okay. So annual cost is how much? Annual cost savings. Cost savings. How much? 70,000. Abi, from year 1, Abi? Abi, no be so.
70,000, sir.
70. Who can tell me why I'm including year 5? Is it a mistake? Is it a mistake?
No, it's supposed to be 4 years.
Supposed to be 4 years, Abi?
No, it's not a mistake.
Are you sure we have made mistake? Are you sure it's not a mistake?
No, it was deliberate.
It's not a
because of
mistake.
the distinct calculations.
What's that?
I said it was deliberate because you're going to use year 5 when you are calculating your tax allowance or so and the rest.
God will bless you.
Yes.
Oh, Jesus. They will bless you. Thank you. So, the rate 1 year in arrears. What does it mean? Who can explain the meaning of 1 year in arrears? Simple terminology, like what is 1 year in arrears? Yes.
A year ahead. No, a year before, a year behind.
I don't understand.
Arrears is like
just use simple examples so people can understand. Yes.
Yes, maybe
the prepayment has already been made.
Prepayment. I just say 1 year in advance, so in arrears. Just use example
before,
like example.
A previous this thing that has been made now.
A year
just
before.
Say, year 1 tax. 2020 tax will be paid when? That's the simple way. 2020 tax will be paid when?
2019.
2020 tax will be paid when?
We pay 2021.
2021.
That's
2021.
Now you are owing now. You did not pay 2020 tax in 2020. You are moving into 2021. That is why they call it arrears. You are owing for 2020 now. Do you understand? Yes, So it therefore means that year 4 tax, this year 4, will be paid when?
We pay year 5.
That's why I included 5. So anytime you see in a question that tax will be paid in arrears, just go and include 1 more year, the number of years given to you. It's very simple now. Any question? Any question? Talk now. Any question?
Yeah. Okay, sir.
We are good at it.
Yes, sir.
All right. Okay, no worries. So I'm using method 1. Okay, I'm using one method. Method 1. Let's just call it method 1. This is a very simple question. There's one more thing we have not captured. Though. We have not captured after we sold for 25,000, Abi. This 25,000 is it an inflow or outflow?
It's an inflow, sir.
It's an inflow.
Inflow, Abi. So I can come here and say 2 things I can do. I can say scrap value. and put it when?
Yes,
Five. Why
You
are no
and
longer the last year, either 5 or 4.
either 5 or 4. And it's not me that taught you.
And the last year, when you're no longer using the asset again, it's now to
That's year
0.
4.
Yeah,
That'll be year 4.
Yeah.
So if you check, some materials will do it like this. Some materials will just come and put 25 here. It doesn't matter. Let's check what they did here. Okay, this is what we are using now. So 200,000, 000, look at what they did. 5. You see it now. So it depends on anyone you want to do. I'm just letting you understand all these things in case you are reading multiple materials. You will not be confused. Yeah. So you can just put your 25 there. So this place will now be outlay / scrap value. Or you can create another new line and say scrap value and put a 25. Anyone is the same thing. You understand? It's the same thing. That will be all. Let me cancel this one. Okay. Okay. So the next one will now be our tax, Abby. Our tax. So what is asking? Is there a format? Like, do I need to know a format to calculate this thing? Ladies and gentlemen, no format. No format. You see this outlet I'm putting as number 1. If my brain touch now, I can vex. I will remove it as number 1. I'll remove this outlet now. I'm going to put it last. They did not bother examiner to fail me. It's not possible. So in case you are thinking in your mind, how will I be cramming this thing? There's no format. Just putting your figures, inflow, outflow. Just be putting your figures, inflow and what? Outflow. Finish. That's what you are doing here. So in this particular question, okay, what are the inflows? The inflows are what? The 70K, which we have treated as an inflow. Then what? The 25K, which we have also treated as what? An inflow. Abi now. Then this 200K, which is what? An outflow. Abi now. What again is this?
Yes,
What again? Let's come back. What again? This depreciation now. Depreciation is an outflow.
Outflow, yes.
But listen, but this depreciation, let me bracket it. I will use it when computing my tax.
Using balance method.
Okay, in this method to affect my tax. What again is in this question? Income is payable. That's my tax. Okay? So my tax is an what? It's an outflow. Okay, so just identify what is coming in, what is going out. You understand? What is coming in, what is going out. It's your brain to just analyze, you understand? And give us what we want. That's what we are doing. So let's do our tax. Our tax. How do we compute our tax? That's what they computed. That should be this. This is our tax computation. So let me just do it for you here. Sharp workings. Please, if you have any question, let me know. So the tax for year 1, year 2, year 3, and what? Year 4. This cost savings is like profits. Yes or no? It's an inflow, Abi. You receive money, Abi. 70.
Yes, sir.
70. 70. 70. That's what I'm doing. Look at what I'm doing here. Okay. That one now. Who is that one? Okay. Now, from this cost savings, we are supposed to remove depreciation. Okay. So it is depreciation they call written down value. Okay. Written down allowance. Okay. That's what they call written down allowance. That's your depreciation. All right. Once you remove your depreciation, you will now have taxable what? Profits. Abi? So it's on this taxable profit, you will now calculate your what? Your tax at how many percent? At 30%. It's your normal P&L structure. Okay. So if you made profit, which is this, then if you remove depreciation, you now get profit afterwards, depreciation, which is it as your taxable what? Profit, which is this. Then since it is taxable, put your tax on it. And once you put your tax on it, you will not get your actual tax figure. And that's what we are looking for. The tax figure, that's what we are looking for. So we can get our tax figure from here. Okay, let's go. So how do we calculate our depreciation? Let's go. Depreciation. So in this case, I want to be calling it like capital allowance. Yeah, I want to use the word capital allowance. Please, this depreciation does not know it, even if they are in professional level. Now, so I can just say yes. I will follow their format here. Yes, okay. This part that they say capital, okay, capital. Capital, you can call it investments, whatever. Then we have allowance. This part they say allowance is usually depreciation, but we'll just say it is what capital allowance. You get it now? Then we'll now put tax savings. Tax savings. They say yeah, due is not necessary, but you need it. Please mute, please. So I will need that year due. In some solution, you don't see it there, but because the person is expert, the person is good, that's why the person was able to solve it. But let me put it here as year due so you can understand. So let's start. In year 0, how much was the investment? The cost of the investment was how much? 200,000. Abi?
Yes.
No depreciation will be charged in year 0. So depreciation will start from year 1. Year 1. Abi? Year 1. So the written down allowance, or what you call capital allowance, will now be at how much? How many percent? 25%. See it now, 25%. So do it for me. Do 25% of 200,000.
50,000.
At 25%. It simply means that our depreciation or capital allowance that will go out of this asset is what? 50,000. What will now be the net book value?
150,000.
Okay, 150,000. So this 50,000 that you are seeing here, bring it separate here, please. Mute. Let me take that person out. Don't worry. Let me take that person out. Okay, so just bring the 50,000 here. Let's move to year 2. Year 2 again, you will charge what? Capital allowance, written down allowance. At how much? 25%.
5%.
And they said it's on reducing balance, Abi. So you do it on 150,000. If it was on cost, you do it on 200,000. So because it's on reducing balance, you do it on 150,000. So do it for me. What do you get?
37,500.
That's 38,000 approximately. So take it out. What do you have as your net book value at the end of year 2?
112.
112,000. So this 38,000, bring it out. So let's say here is in 1,000. Here is in 1,000. So 38. So year 3.
Somebody approximated to 38,000.
You got 37,500. That's going to be like 37.5.
Yes.
That's about 38,000. Okay. It doesn't matter. If you like, put your 37,500. It doesn't matter. I'm just trying to make sure I get similar answers like them. You understand? So
okay.
So do it again.
28,000, sir.
28,000.
Yes, sir.
Oh, you help me minus it.
84,000.
84,000. Okay, so bring it out. What do we have?
58,000.
28. Where do you see 58,000?
28.
Okay. So for year 4?
At 25. That would be 21,000.
That's how much?
21,000.
Minus 84.
63,000.
Clap for yourself. Okay, so.
Okay, so is it because of the? Don't worry, continue.
Say it now. Even if you are wrong, I will not insult you.
I want to know, is it because of the last year is the year we're actually selling this
No,
thing?
it stopped recording, that's why.
Yes, it is because the last year was the year that we sold it. You understand? So in investment appraisal, look at it. They said that it would have a life of 4 years which it would be sold for 25,000. I know we are always calculating depreciation at the end of the year. So at the end of this fourth year, what we are doing is that we are selling. Okay, we are selling. Are you getting it now? So since we are selling, there's a way we usually treat it when we sell. How much are we selling? That's the question. How much are we selling? I don't understand.
We are selling for 25,000.
25,000.
That's it now. You are selling for 25,000. So that's the scrap for 25,000. So something that, you know, this 84,000 is the closing balance of the asset as at year 3, Abby?
Yes.
Which is the opening as at year 4, Abby? So you now sold it for 25,000. So 84 minus 25, what do you have?
59.
Are you sure?
59,000.
Okay, good. 59. So 59,000 is the actual depreciation that left that asset. Is anybody confused? So bring your 59 here. It's simple now. You are buying the financial report. So that year that the asset was sold, what you simply do is that don't calculate depreciation. That year that the asset was sold, what happens is that don't calculate. Wait now, wait, can you hear me? Wait, can you hear me?
Yes, sir.
Wait now. That year that the asset was sold, don't calculate depreciation like the 25% that you were doing. What you just do is put in your scrap value, which is your 25,000. An asset that you resume with for 84. You now sold it for 25. It simply means that what depreciated from that asset is what? Is 59. Yes or no?
Yes, sir.
And now it's common sense now. Oh, yeah, go ahead. Who is asking a question?
Sorry, sir. I was logged out the other time. I could not even hear anything. I could not see your screen. So I have to log out and log in back. Please, can you please come again, sir?
It's record now.
Where am I coming again? Because I've said a lot of things. I've even given birth to a baby since. So are we trying to give birth to the baby again? Or which one? Which part did you know?
Yes, sir. From this capital allowance.
Capital allowance, okay. Were you the one who did year 1, year 2, year 3? Or you were not there?
I was there, but I was just following. I didn't really get what we're doing.
So capital allowance is depreciation. So what we're trying to calculate is just depreciation. So the year 0 is the cost of the asset, which is 200,000. But you will start calculating depreciation from year 1. Abi now. So in year 1, okay, you calculate 25% on your 200,000. That gave you 50,000. When you subtract, the difference is 150,000. That's your net book value, or what you call your tax written down value. Okay. So for year 2, you calculate another 25% on the 150,000, and we got 38,000. And when we subtracted, we got 112,000. That's our tax written down value or net book value. Then in year 3, we did another 25% on the 112,000, which we got 28,000. And when you subtract, you get 84,000. That's our tax written down value or net book value. But this is where the beauty lies. This asset will last for 4 years. Everybody knows. So in the 4th year, okay, that was when we will sell the asset. We'll sell the asset. We'll assume that we sold the asset. Now, when we sold the asset for scrap. The amount to sell an asset is not a scrap. And what did we sell the asset? 25,000. So we didn't need to do depreciation of 25% again, because depreciation of 25% on 84,000 will not give us the actual depreciation that left the asset. So what we needed to do was to say, okay, if we sold the asset for 25,000 and the asset actually worth 84,000, then what is the actual or the real depreciation that left the asset? 84 minus 25 is what? 59. I don't know if I'm making sense. Did you get it up to that level?
Yes, sir. Thank you, sir.
Good. Now, where I want you to understand is that When we talk about capital allowance, please pay attention. Two things are bound to happen when you are selling an asset. What are the two things? Who can tell me? For taxation purpose, when you sell an asset, what are the two things that are bound to happen? If people do not know it, let me just put your tax lecturer on this call now.
Capital charge.
Capital what?
Sir, let me try. I think capital gain or balancing charges.
You said capital gain or balancing charges?
Balancing charge.
Jesus, you are so good. Hallelujah. Okay, thank you very much for that. But it is balancing allowance or balancing charge. So do you get it now? Have you heard of these two terminologies before? Oh, advanced tax student, talk to me. Have you heard of the word balancing allowance and balancing charge?
Yes.
Yes, sir.
Yes, sir.
We are borrowing knowledge. You understand? We are borrowing knowledge from different fields, so you will know how these things are linked. So respond to me so that I will understand. So if you know, you have heard of balancing allowance and balancing charge. Together, what do we call them?
Capital allowance.
You are who? Together, what is the name for them? Just like saying John and Johnson, but they are twin. Together, they are twin. Abi? So balancing allowance, balancing charge. Together, they are known as what?
That's tax allowance.
No, let me call name. It's not tax allowance. Yeah, it's not tax allowance. Professional student, do justice to this question. Lecturer, where are you? Talk to me now.
Please, what's the question?
You will not hear that question again because I've been saying it's not. I know you want to ask me.
Sorry, I was logged out, so I just came back.
Is it lecturer?
Yes,
No,
sir.
it's not.
No, it's not. Sir.
Okay, balancing allowance and balancing charge together. What is the name that we call them? Just like saying John and Johnson. If they are twin, we say together they are twin. But individually, they are John and Johnson. So this one are balancing allowance, balancing charge. Individually, they are balancing allowance and balancing charge. So together, what do we call them?
Balance.
Isn't that balancing adjustment?
Thank you. Balancing adjustments. Balancing adjustments. And you know the funny part is in some people's note. Is in some people's note. They did not still know it. They don't even know the meaning of it. Can you hear me?
You can hear you, sir.
Yeah, who can tell me what is balancing allowance and balancing charge? That's where I'm stopping. I'm stopping in this question. That's what I'm doing. After this question, I'm done. Everybody should go and rest. What's balancing allowance and what's balancing charge?
Let me try. If I can remember, actually. So I think balancing charge or allowance is when you sell the assets lesser than the written down value, and why the charge is the other way around. Am I correct? Can't remember.
Now try.
Lecturer, is that you?
Yes.
Okay.
Oh yeah, try.
Okay. So the balancing allowance is when the asset or an asset is being sold for less than its tax written down value. That's when you get an extra allowance. Why the balancing charge is when an asset is sold for more than its tax written down value.
Thank you. Thank you. There's a reason why we call you lecturer and you don't fail. Just that sometimes you used to fake question. I don't know what happened to me. Thank you. The same to what the lady have said. I don't know. Maybe something similar. All right. So the word balancing allowance and balancing charge only arises when you are selling an asset. If you don't sell an asset, there's nothing like balancing charge or balancing allowance. There's nothing like that. So one of them is profit on the sale of assets. So this balancing charge is only when you make profit on sale of assets. we'll charge you tax on the profit. But you see this balancing allowance, okay, is when you make loss. So we'll give you relief. We will not charge you tax, we'll give you relief. All right, we'll give you relief. So this balancing charge is more or less like a minus, and this is like a plus. So balancing charge are collecting money from you in form of tax. Balancing allowance, they are like giving you money through relief. Does that make sense now? Now, in this scenario, who can explain what is happening to me when we sold this asset for 25,000? Did we arrive as a balancing allowance or at a balancing charge?
What? So balancing allowance.
Balancing, you should be proud now. Be proud of what you know. Is it balancing allowance or balancing charge? This asset is worth 84,000.
Balancing allowance. And it was sold for 25,000.
Yes, and it was sold for 25. Did you make profit or did you make loss?
You made loss.
If you make loss, where does it belong to?
Balancing allowance.
Good. Am I making sense?
Yes, sir.
All right.
No.
So for
Please,
balancing
sir, can
allowance,
you come again with that explanation? Sorry,
I did not
sir.
explain anything. Did I say anything? Not me. It's somebody that
What's
said.
You said something. You said something.
Okay, I said something. Is it true? Okay. The person said that 84,000 is the cost of the asset. Is that not what the person said? And you sold it for 25,000. The person now asked, did you make profit or did you make loss? To answer the question, did you make profit or did you make loss?
Made loss.
Good. Whenever you make loss when you sell an asset, is it a balancing allowance or balancing charge?
I think it's around. It's
No,
around,
don't
sir.
think. It is allowance.
Okay, sir.
Don't think. Here we have stopped thinking. We have known. You understand?
Okay, sir.
So here is allowance. Here is if it is profit, it is balancing charge because we are going to charge you tax. Just use that idea.
Yes.
Charge. You're charging me tax. Allowance. You are giving me relief. You understand?
So, sir, assuming we sold for more than 84,000, it will be a case of balancing charge.
Exactly. Exactly. And we are going to tax it. That's the most important thing.
Okay.
Are we good now? So this 59 you are seeing here, rather than calling it depreciation, okay, we can clean it up and call it balancing allowance. Okay, so balancing allowance. And that was the idea that this person used there, balancing allowance. 59,000. It makes sense. Okay? All right, so this 50, we'll put it here as 50. This 38, we'll put it here as 38. This 28, we'll put it here as 28. This 59, we'll put it here at what? 59. So there's no rocket science about this figure. Now, what is the tax savings? What is the tax savings? What is the tax savings? Now, our tax is how many percent? I mean, what's our tax? 30%. I mean, 30.
30%.
Yeah, 30. So 30%. Right. So that's the percent of 50 for me. Especially 30% of 58. 30% of 28. That's 59. Is tax savings. You get
15,000.
15. 15. Next one.
11,400.
11,400.
11,400.
I don't understand why you say 11.
11,400. 11,400.
That's 11.4. Okay. I think here they removed the
Yeah.
decimal. Okay. Let's just say 11.
So the other one is 8.4. So it should just be 8.
So let's make this one just 11. Doesn't matter. In your exam, you can put everything. No, it doesn't change anything. No, before you cover me and say, doctor said. He said, and he has doctorate. Oh, yeah, do for the last
So
one.
the other one is 17.7. So that would be 18.
18. Now, who can tell me the year due? Now, this year due, you follow that principle of arrears. So the tax in year 1, when are we going to pay it? Year 2.
Year 2.
The tax in year 3, when are we going to pay it? Or let us say the tax
Yes.
savings, when are we going to enjoy it? Year 3. The tax savings of year 3, when are we going to enjoy it?
Year 4.
Tax savings of year 4, when are we going to enjoy it?
Year 5.
Any question?
No, sir.
Sọ̀rọ̀ sókè. Oh yeah. Are we good? Yes, go ahead.
Okay. If this asset would have, I mean, it was sold for 90,000.
Don't worry.
That means the scrap value is more than the value of the asset by 6,000, because we take the difference between 90 and the 84, which is 6,000. And in that case, are we going to write it as balancing charge where we have allowance there at 6,000? And how will it now affect this allowance column?
Don't worry. I know that you will ask that question. Don't worry. Fọkàrẹ́ balẹ̀.
Right, sir.
Fọkàrẹ́ balẹ̀.
Sorry, sir. Sir.
I know you people will ask that question. Let's take it step by step. Let's finish this one. See, I have over 15 questions on that. So let's see what we can do. Because if I say it now, you will still forget. Some people will still forget. There was a place we were solving something before. Okay, good. So who can give me our figure for capital allowance? For depreciation.
50,000.
50, 38, 28.
38, 28, and 59.
So let's go 50. Let me use
50, 38. 28.
59. Oh, yeah, help me minus
59.
it. Minus it. That's our depreciation.
20.
20.
32.
32.
42.
42. 11.
11. Okay, let's do our tax. Tax at 30%. Do 30% of 20.
6.
6. Next.
32. Sorry.
3.3. Yes.
30% of 32.
For year 4, 3.3.
9.6. So that would be 10.
This one is 10. Okay. This one, okay.
12.6. That's 13.
13. So what is the year due? So in year 1 will be paid in year 2. Year 2 will be enjoyed in year 3 or paid in year 3. Year 3 will be paid in year 4, Abby. Year 4 will be paid in what?
Yes.
Year 5. Are we good now? So this tax that you are seeing here, copy this tax and put in our solution of tax that we're looking for here. So what is the tax? 6, Abby. 10, Abby. 13. Okay, that's 6,000, Abby. This 10 is 10,000. And the other one is what? 13,000, Abby. And here will be what? This is 3.3. 3,300. Are you sure? Any question? Any question? So your income, taxes and expenses. Taxes and expenses. Are we good? Oh yeah, give me figure.
Sorry, sir. Sorry to take you back.
Yes, take me back.
Tax at 30%, 6, 10, 13, and 3.3. Sorry, how did we get it?
30% of 20, 30% of 32, 30% of 42, 30% of 11. That's how you get all these things now.
Okay, then why did we do the other one we did down? Can you scroll down, please?
Which one?
This one where we did tax savings.
This is tax savings.
As well.
Yes, don't worry about this. I'm going to solve another method where I'm going to be using this tax savings. And we are still going to get the same answer. This is method 1. Okay. If you check this method 1, there's nothing like tax savings in the body of this report. The only thing that you are seeing here is tax. There's another one that we're going to solve. You're going to see tax savings and tax. Am I making sense now? You're going to see tax savings and tax. So just follow through first. This working is necessary. This working that I did here is necessary. Necessary. If I'm using this method. This working that I did here is necessary if I'm using this same method and this other method I'm going to be using now. So just stay with me and we're going to compare. I'm going to tell you what to do. Okay, just stay with me. Okay, so give me figure. This one will still be 200,000.
Yeah. Yeah, that will be 70,000.
70,000. Positive. This one will call 64.
64,000.
60.
60.
60. This one will call
82.
82.
Then 33.
Negative. Abi now? So this is our net cash flow, Abi. There you now put your discount factor. What's our discount factor? 7.5, Abi. Look at it here. 7.5%. So let's roll the 7.5%. You will still use that your formula. 1 over 1 plus R raised to n. That's the formula you will still use. So in this case, our year 0 will be 1. Okay. Our year 2, let's just pick their figures. 0.930 is something everybody can do. Then 0.865. If you want to confirm, you can do that from your end. Then 0.805. Then 0. What?
749.
Then 0.
697.
697. So if you multiply now, once you multiply,
So we have minus 200,000.
so here will be
for
200,000
0.
negative. Abi? Then if you multiply this one,
100.
6,500.
65,500.
100.
100.
You multiply this one. You multiply this one.
55,360.
55. 360.
360.
You multiply this one.
48,300.
48,300. You multiply the other one.
61,418.
61,418. Multiply the last one.
23.1.
23.2307.
Like this.
23.1.
Okay. Oh yeah, look for the MPV for me. Add up and minus the 200,000.
It's 2,300.1. The same thing she's saying, sir. 300.1.
Okay, so add up everything like this. You get your MPV.
So without 2 in brackets.
Yes, it's bracket though. Add up everything, take out the negative ones. What do we have? Add up all the positive, take out the negatives. You should get close to this figure.
$27,878.
27,878. Thank you very much. Any question? We still got the answer that they got. Similar to the answer that they got. You know them, they rounded up a lot. But they did not use our method. So any method you are using is the same thing. So let's use method 2. Kia. We don't need to waste much time. Method 2. Method 2. And this is the method 2 here. This one here. M2. So the same thing here, 0, 1, 2, 3, 4, and 5. Are we there? Then our outlay. Our outlay.
Please, what was your final answer on that one?
27 now. Wait for us. Let us 27,878. 27,878. We are coming back. So what's our outlay? 200,000, Abi?
Yes, sir. Yes, sir.
Let's just put our 25,000 what do you call it? Scrap value. Scrap value. 25,000. I can separate it if I want. Than inflow. So here is dash, 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 and dash. All right. There was our cost savings.
70,000.
Yes, dash 70,000, 70,000,
70,000.
70,000, 70,000. Yeah, 5, nothing. Good. Now, what is our tax? What's our tax?
1610.
No. Do your tax on this 70 direct.
Okay, so that'll be tax at 30%.
21.
30%. 21,000, Abby. So this 21,000 is supposed to be in year 1. Take it to year 2. Because that's when it's going to be paid. The one of year 2, take it to year 3. 1,000. The one of year 3, take it to year 4. 1,000. The one of year 4, take it to year 5. 51,000. Are we good now? So let's put it in brackets. After you put your tax, you will now put your tax savings. That's the difference. The tax savings. Now, where do we compute the tax savings?
From year 2.
Look at the tax savings here. That's the reason why we did this thing. So give me 15, 11, 8, 18.
15, 11, 8, 18.
Good, thank you. 15. Positive, or is you are saving 11, 8, and 18. Do you get it now?
Yes.
Yes, sir. Good. Now do 21 minus 50. What did you get?
21 minus 70, 49.
No, 21
That's
minus 15.
6.
6, Abby. Good, thank you.
6,000, yeah.
6,000, Abby.
Yes.
Do 21 minus 11. 10, Abby.
10,000.
That's 10,000.
Do 21 minus 8.
That's 13,000.
Let's stop here. What do we have? 6, 10, 15. Go up to the method 1. 6, 10, 13. Are you seeing it now?
Yes, sir.
Yes.
So that's your tax. That's your actual tax. 6, 10, 13. So here we put the tax direct. Here we showed the tax and the savings. So if you look at it net wise, it's still working back to what we have done before. That's just what we did. Oh yeah, figure me. Or is there anything that we have not picked that you think we should have picked? We don't need depreciation because depreciation was used to calculate this tax savings. So in case your mind is going to depreciation, before we calculated our tax savings, this is our tax savings. Was it not on depreciation?
Yes, it was.
Depreciation. So we don't need depreciation here again.
Yes.
But in the first method, you needed depreciation to calculate. Look at it. You deducted your depreciation first to get your taxation, to get your taxable, then from taxable, you now taxed to get your actual tax. In the second method, you don't need depreciation again because the tax savings that you have picked was gotten from your depreciation. That's the difference. So anyone that is pleasing to you, you do it. The one that we usually use more if we're solving ICANN question is method 1. You get? We use method 1 to solve ICANN question. All right, so give me a figure now. Yeah, it'll still be 200.
200. 70,000.
70. Yeah, uncle.
4,000.
64,000.
Yeah, uncle.
60,000.
Okay.
57,000.
It's not 57.
Sorry. Hey.
70 plus 8,000 minus 21.
57.
Is it 57?
Okay, plus 25.
No,
Yes,
21.
plus 25 up, yes.
Oh, okay.
That's 82.
82,000, sir.
The last one.
Minus 3,000.
Are we good now? So this is now our net cash flow. The next one is what? Discount factor, Abi, at 7.5. So here will be 1, Abi, 0 0.930, 0 0.865. I'm copying from here. Okay.
0.805.
Okay.
0.749.
Which one again?
0.697.
0.697. All right, makes sense, Abi. So let's multiply. Let's multiply.
6,500.
6,500. The first one, Abi.
Yes, after 200. Yes.
Yes, 200,000.
The last one, 2,091. Negative.
Okay.
Then we have 55,360.
55,360. The guys have given up on their career. Okay.
48,300.
48.
6148.
48,300.
418.
The next one.
61,418.
61,418. So if you do the mathematics, what is going to be our MPV? Okay.
28,087.
28,087. We're supposed to have similar answers. Okay, so you can do that on your own again. So my question is, based on the presentation of method 1 and method 2, which one do you find interesting and easy for you? Method 1 or method 2? This is method 1. Which one do you find easy? I don't know yet.
I think I prefer method 2 to
Method
method 1.
Method 2.
Nobody preferred method 2. Why you prefer method 2?
Yes, sir. Maybe because I've already
Short
calculated
term.
everything.
Please go and know method 1.
Okay, sir.
Go and know method 1. You can have different streams of income. You will not be shocked. Which income should you apply your tax on? So go and know method 1. But it's fine. So method 1 is mostly used in their past questions. It's mostly used. Okay, so that is where we'll be joining our cutting for today's class. In our next class, in our next class, we'll be looking at questions that addresses the following. Questions that addresses taxation, question that addresses inflation, question that addresses working capital recoupment, and that will be all. These are the 3 basic in an MPV question. These other ones can be seen as a topic on their own too, you understand? But they also come in a investment appraisal way. So we have a lot to do. This Saturday, I will meet with my professional students and address past questions that attract these variables. I also do that for our skill students when we meet. Take your skill particular question and address what we have, ladies and gentlemen. I remain Dr. President. Thank you for your time and thank you for staying with me.